All right. Good morning, everybody. Thank you for that, John Novak. Guys, there's yesterday's class. John just posted it in the room. Man, yesterday was good. A lot of great things going on. A lot of great questions. A lot of great lessons on management. A lot of great lessons on patience. So, um, it's cool to review these things. If you ever watch class and you have an aha moment, it's nice to be able to go back and look at it. D Rock, nice to see you back in here. Dwight, Samuel, Ron, Jim, Chris Novak. It's a good last name. Chris L. Shep, Alex, good to see you guys. Small crowd so far today. Everybody hear me okay? You guys doing all right? Let me make sure that my headphones are plugged in. Am I echoey? Yeah, because I'm coming off the laptop. Clear it up a little bit. No, I use the AirPods. So usually, sometimes they connect automatically, and sometimes they don't. So I never know what I'm gonna get. Man, did you guys watch that news today? Hey, good morning, Snorri. Good morning, Dwight. 8:30 a.m., guys. News went absolutely nuts. Made that market go crazy. I hope you guys saw it. Good morning, George T. I hope you guys knew it was coming um, because you checked forexfactory.com and you noticed those red boxes at 8:30 a.m. Unless you've got too much hot air, I've got all the hot air. Guys, at 8:30 a.m. there was the core CPI, CPI, MMYY, all high impact, and man, it made that market rocket. It was fast. It was changing directions. It was bouncing all over the place. Let me show you what a market looks like. I'm going to pull up my large chart on the NASDAQ real quick, and I want you guys to see this just from the NASDAQ, right at 8:30. So I'm going to find the 8:30 timestamp, and I'm going to put it all the way to the right. We'll just leave it 8:31. All of this happened within 60 seconds, guys. All of this movement, all of this, um, it was crazy. It was chaotic. But the other thing that I want to show you is that Fibonacci resistance held. Fibonacci support created a bounce. Resistance to support, resistance to support. There was a huge fight. Good morning, Jose. And it made it right to Fibonacci support, right back to Fibonacci resistance. Guys, look at these fibs hold. There is no reason for you to ever get caught trading into one of these areas. And then everything's set up, and sure enough, it went up. And then it hit those key areas, and everything set down, and sure enough, it went down. And everything set up, and it went right to the key areas. And now we're waiting to see what happens. Guys, even during news, the patterns repeat themselves. Even during news, momentum leads the way. Even during news, termination conditions can reverse the market. And when it happens at such a high speed, it reminds you that you're not in control, that the people that move the market are recognizing these areas, guys, and they demand respect. So we're going to talk about, I guess, respect a little bit today when we look at the markets, and we're going to talk about advantages, and we're going to talk about getting in. And I'm not going to lie, guys, I woke up this morning with analogies racing through my head. I woke up with analogies about what it's like to learn to day trade. I woke up with analogies about what it's like when price reaches areas and why we respect termination conditions. But I want to share this with you because, guys, I'm very right-brained. I'm an artist. I draw, and when I learned to draw, I learned to draw through repetition. I pick something that I want to draw, and I draw it 1,000 times. But at first, I trace it, and I traced it, and I try to develop muscle memory, and then from that muscle memory, I begin to go through it. But everything is shapes when you draw. And this was I googled how to draw a rabbit. Um, And guys, this is very much the same as your learning journey. Anybody can draw a rabbit. Hey, good morning, Dominic. Guys, anybody can draw a rabbit, right? Especially if you don't wake up and say, "Hey, I'm going to draw a rabbit." If you say, "I'm going to learn how to draw a rabbit," right? I'm going to embrace the process that it takes. And this is kind of what it is, guys. You end up with a rabbit, but you build off of individual pieces, right? And it gets a little bit closer every time you learn something. And this is what it's like when you're learning to trade, guys. Um, we're going to do it with a foundational approach. We're going to attack trading the same way that you attack eating an elephant, one step at a time. So we're going to focus on identifying the trend, and then we're going to get momentum, and then we're going to do termination conditions and entries. And I want you to allow it to be a journey, and I want you to allow it to be easy and simple and focused. Because if you do that, your life is going to be easy and simple and focused. So there's a couple things that need to happen to get you where you want to be, guys. And the first one, and I'm talking to you, D-Rock and Atif, and who else is in here that's brand new? Chris L. Guys, I want to see pictures from you. Every time you have a question, I want you to post a picture with a question on it. Every time you think you see rules met, I want you to post a picture with the rules met. Every time you think the rules aren't met, I want you to post a picture and tell me, hey, Mark, this is one of those termination conditions. These are those weak triggers. And I want you to get in the habit from day one of posting your trades and your questions in picture form in the classroom. Because if you do that, you're going to get a private session with me every time. You're going to get a one-on-one session with me. And we're going to talk about everything. We're going to talk about what you see. We're going to talk about what your charts were saying. We're going to talk about how you felt. We're going to talk about what you did amazing. And guys, I love to celebrate victories, but we're also going to talk about maybe some challenges that you had. So get in the habit every day of posting pictures. D-Rock, are you comfortable posting pictures? Atif, are you comfortable posting pictures? Okay, you are? Cool. Guys, TechSmith Capture is the easiest tool that you're ever going to use. And if you click that giant red capture button, it's click and drag. So here's what I need from you guys. I need you to click from the top left to the bottom right. Give me your whole workspace. And when you release that mouse button, it's going to give you the option to take a picture. Of course, it did it me over on my laptop screen. And when I capture this image, there's your capture image preview, guys. And this is how we're going to have a conversation. This is how you and I are going to talk each and every day. I need you to write your rules on the chart. I need you to write what you see, what your question is. I want you to use arrows. You know, hey, Mark, was this an entry? Was that an entry? Hey, Mark, this looks like Fibonacci resistance, but everything went through it. Is there any indication letting me know that that may happen, right? How do you log into the library? I'll show you. And then once you put your stuff on here, guys, I want you to write. I want you to bang it out, to write those rules on the chart. And then just simply click copy. It's going to put it on your clipboard. Drop it in the room. Let's have a conversation about it. And then D-Rock, if you pull up the internet and you go to screencast.com, whoops, that was just somebody's picture. If you go to screencast.com, whoops, I have to sign in. Dun, 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 dun. Once you go to screencast.com and you log in, there's going to be your library. Everything that you've taken pictures of, the stuff that you've posted, all that good stuff. And it looks like there's a new screencast that's been optimized. And let's see if this one lets me sign in. There it is. So now I've got a new library. Apparently I've got a couple libraries here. Yeah, but screencast.com will get you squared away and take you where you need to be. Guys, get in the habit of posting pictures every day, as many as you can, as many as you want. Because the more pictures you post, the more feedback you get. And the more feedback you get, the more consistent you become. The next thing is use your spreadsheet, guys. Every time you take a picture, put it in your spreadsheet. If you take a trade, use that first page of the spreadsheet that Nexgen provided you. Good morning, Bobby. Um, you're going to put in your trades, how you felt, what was going on, the rules being met, the rules not being met, and you're going to put notes in there about how it made you feel and all that good stuff, guys. This isn't some arduous process to keep you busy in between trades. This isn't me giving you busy work because idle hands are the devil's tool or anything like that. Guys, this is how you're going to get to where you want to be because every morning you're going to study the previous day's trades. And every morning you're going to ask yourself what worked and what didn't work. Hey, good morning, PFI. You're going to ask yourself what felt easy, what felt forced. You're going to recognize patterns in the market that you're trading that are bringing you success. You're going to recognize patterns in the market you're trading that's going to take away from your success. But the most important thing that this page of the spreadsheet does for you is it recognizes patterns in yourself. If you have a tendency to jump in early, to get out early, if you have a tendency to break rules, you're going to begin to see that through the notes and through the feedback that you're giving yourself. So 5 minutes every morning will set you up for success for the day, guys. It's going to get you fresh-brained thinking about doing all the things you need to do to be successful. And then it's your pictures in the room are where I'm going to find the patterns in you, guys. I'm going to see what you're doing. Maybe you take the perfect trades, but you jump out at a tick because you're terrified, and that's normal for a brand new user. Maybe you get so anxious about the entry that you jump in too soon and get stopped out at the perfect spot to enter, and that's totally normal too, guys. It's a part of the trading process. It's a learning process. So let's keep the communication full blown between us. We're going to take the first hour and we're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. Guys, I'm going to talk about a high probability trend trade first. I'm going to talk about a trade where every trigger on every chart agrees for the trade, where the triggers are the strongest. There's nothing in your way. And I literally woke up with a lesson on termination conditions today. And I'm excited to share that when we get to it. I need you guys simulating. I need you firing up your Ninja Trader. And I need you practicing trades. I need you practicing the correct trades. I need you telling yourself each and every morning, I'm going to follow rules today because rules give me a statistical advantage. I'm going to follow, yeah, it's 23rd. Absolutely. That's NASDAQ. Hold on. Let me give you a look, Dwight. Yep, 45.11-ish. It's coming down. But absolutely, you're right where you need to be, bud. We're going to talk about high probability trend trades first. So D-Rock, this is your foundation. Atif, this is your foundation, guys. Chef, Snorri, Chris L. Guys, this is the trade that's going to build the most solid platform that you could ever have. This is the trade that's going to teach you to read your indicators. And what you're going to find is that 90% of what you do during the day is reading indicators. 90% of what you do during the day is looking for advantages, looking for the market to tell you. We will, D-Rock. I'll tell you what, let's do that towards the end of Classroom because what happens is I have to shut everything down to do it. But there is the link with a video that walks you through it 100%. That's really, really simple. Most people have it figured out and mastered the first time, second time, third time. It took me, I think, 3 times to do it. But on Ninja 8, it's super easy. And we'll go over that. Remind me towards the end of the classroom, though, okay? But there's your video. There is your how to fish, and then I'll give you a fish right at the end of the day. Guys, you're going to learn how to read your charts. You're going to be a chart reader. You're not going to be a day trader first. You're going to be a chart reader. But when you're a chart reader, you're going to understand 3 very key concepts. You're going to understand where the market is likely to continue. And when you understand and can identify where the market is likely to continue, you have your entry points for these high probability trend trades, for these trades that typically win 70 to 80% of the time. You're also going to understand where the market is likely to go. You're going to use Fibonacci. You're going to use momentum, And you're going to understand when that market has the opportunity to get to that next key area, when all of your indicators are telling you that this red line off in the distance is a beautiful target. It's a great profit taking area because that is where the market is likely to go. And then finally, you're going to understand where the market is likely to stop. And it's hard for me to overstress the importance of this. Where the market is likely to stop can end the trend. Where the market is likely to stop can create a giant fight between buyers and sellers. And where the market is likely to stop can completely reverse a market. And when these areas where it's likely to stop, we call them termination conditions. When the market reverses from a termination condition, guys, this sets you up for the absolute highest probability trend trade that you can take. The trade with every advantage coming from the absolute best place. The trade that typically wins 70 to 80% of the time. And that's what we're going to focus on in this first hour, guys. We're going to focus on the high probability trend trade. You're going to simulate it. You're going to keep posting pictures. And then my goal every day is to simplify, to make this so easy that even a caveman can do it, right? Um, we're going to simplify. We're going to start with the high probability trend trade. That's going to be your base, your foundation. That's what's going to teach you to read your charts. And then from there, once you're a chart reader, you can do anything, guys. You can chase all these other trades you see people taking. You can work your way into what we call medium probability trades. And medium probability trades mean that most of your indicators line up for a trade. However, a small issue exists, and your ability to read charts is going to identify that small issue. Um, Medium probability trades are going to have to be managed more assertively than high probability trades, which means that your chart reading is going to allow you to manage these trades, to get to a zero loss level quickly, to understand when it's appropriate to take profits and when it's appropriate to hold longer. But guys, all of that ability to branch outside comes from your ability to read charts. So we're going to learn the rules. I want you to practice them. And I want you to take a billion pictures so that they become easy, guys, because the more times you see a beautiful trade entry, the more times you see fantastic management, the more times you annotate your chart. This is what I see, and this is what happened. Guys, that's when you're going to get to where you want to be. That's your step-by-step path to becoming a confident trader ASAP. And I want to find a quick picture. I lost it. I took it yesterday, I think, or day before. So forgive me while I go through my library real quick. But I gave you guys a how to annotate your charts picture, and I think this is it right here. This is it. Guys, this is what I need from you to give me the absolute best information every time, um, every time you take a picture. And I'm going to save this in my file so that I can use it every day. But chart annotation is nothing more than a conversation. It's a conversation between the two of us. It is also a conversation between you and yourself. Ooh, that's really big. Um, so when you annotate a chart, I want you to always show your large chart and I want you to always show your small chart. I want you to show me both charts. I want you to write your rules on the chart, whether it's a high probability trend trade, a momentum trade, an HVA trade, if it's an edge trade, if it's a gap theory trade. I don't care what kind of trade it is, guys. We're going to relate it all back to advantages. But I want you to write your rules on the chart and I want you to point them out with arrows, your rules being met. And what this is going to do for you is this is going to increase consistency. This is going to get you the visual going with the verbal. You're reinforcing the looks that are bringing you success, that bring you advantages. And then the second half of that is you're going to be able to police yourself when you break those rules. If you get in the habit of writing the rules for entry on every chart you take a trade, you're going to recognize your patterns quickly if there's a rule that you like to break. I want you to show the timestamps and I want you to show the prices so that your large chart can be lined up with the small chart. This is very important because we teach a two-chart setup. And then finally, if you haven't ever done this, guys, I want you to right-click on your entry chart and make sure that you're plotting your executions, that you're showing me where you entered and where you exited. And this does a couple things. One, it lets me see exactly where you got in. which is huge for the thought process, and it's going to help me help you. But it makes it easy to do the math to see the money you made for those of you that are math people. So, guys, annotate your charts. This is the absolute best version of how to do it that I can give you. Embrace it a little bit. And then we're going to talk about this high probability trend trade. There's only three rules, so there's not a lot to write on your chart. There's three rules for a reason. One, because it's simple. Three is not a big number, right? Three is the magic number. And these three rules create three advantages. These three advantages are the recipe for a trade. So your first rule is strong trigger lines, and that's going to give you the advantage of momentum. And your second rule is none of those termination conditions should be there, and that gives you the advantage of a clear path. And then finally, we're going to have a rule for entry where you're using a limit order. You're going to pinpoint, you're going to call your shots, and you're going to use a limit order to enter at areas inside of triggers, guys. Three simple rules for a high probability trend trade. Three simple rules to put you in a trade that gives you the entry for the trade that typically wins 70 to 80% of the time. This is only entry, guys. And these entry rules happen on three charts. The large chart leads the way. The large chart is going to define direction. The large chart is going to define momentum, and the large chart is going to define the areas, guys. And if you allow the large chart to do its job, you will never even look at a small chart until both rules 1 and 2 have been satisfied. When rules 1 and 2 are met on the large chart, you will have the advantage of momentum, and you will have the advantage of a clear path. And guys, when I say a clear path, I mean nothing between you and your potential target. Smooth sailing. The large chart is a broad stroke of a brush. And it's really showing the overall opinion of the market. It's showing what the large crowd, what the people that move the market want to have happen. And this is a sad realization for a lot of us that are control freaks. You don't control the market. You'll never make it go up or down with your 5 contracts. You'll never make the market reverse by taking profits from your 2 lot. Guys, there are institutional traders, people with millions and millions of dollars behind them that are making this market move. We are going to take advantage of what they do. So when their opinion is that the market should go up, if their opinion is that the market should have momentum, and their opinion is that there's no areas where they want to react, that's when we have these advantages, guys. And then we'll refine it on a small chart where the people who love to fight the large crowd sit. The people that love to fight the large crowd, they're going to get you to your perfect entry, guys. So we use this refinement process. Whoops. Large chart says it's time to look for a trade. Small chart is going to refine that broad stroke of a brush. Small chart is going to pinpoint the area where the market is most likely to continue. And the small chart is going to allow you to get into the market at a point where you can reduce risk and absolutely maximize your profit potential, guys. So 3 simple rules, 2 charts. I want you guys to embrace the idea that the less you have to think about, the less rules you give yourself, the less charts you give yourself, right? The less conditions that have to be satisfied in order for you to take a trade, the easier it is to find the trades, guys. And we're not looking for the entries, we're looking for the trades. We're looking for the culmination of 3 advantages on only 2 charts. So let's take a look at that. I'm going to go to the education page right off of nexgent3.com education. We're going to click on the tutorial section. And when we click on the tutorial section, it's going to take us to rule number 1. T3 trigger lines define the trend is what the section is called. And I'm going to show you how they do that. And I'm going to show you just how easy it can be. This is the first piece of the puzzle for everybody, guys, is let's define the trend. Let's make sure that we never fight the trend, because the trend is what the people that move the market want the market to be doing. If the background on your large chart, your 13.2 on the crude oil or the S&P is green, guys, you're in an uptrend. You're only looking for rules to be met for high probability trend trades long. If it's red, you're in a downtrend. You're only looking for rules to be met for high probability trend trades long. And guys, just because it's green doesn't mean that you're jumping in the market. It means you're looking for rules to be met because your rules provide a statistical advantage. And if it's red, we're not looking to just jump short in the market. We're waiting for our rules to be met. And guys, this really is the first advantage that you can give yourself. Simply go with the flow, right? Trade with the trend. Once you've established the trend, guys, rule number one says that we have to have strong trigger lines. It's impossible to have strong trigger lines if you're fighting the trend. Um, there's no way for it to happen. Just can't. Because when your small trigger lines break above the large trigger lines, that's what paints your background green. That's what tells you that it's an uptrend. And strong trigger lines mean that these small trigger lines, the solid lines, have broken above the large trigger lines. These are the dashed lines. It's the separation between the two with both sets wide, angled in the direction of the trend, meaning that there's no space between the lines on them, right? They're not pinched and flat. They're wide and angled. This separation lets me know that the odds are favorable for the market to continue in the direction of the trend. It's impossible to have strong trigger lines if you're fighting the trend. From the point of separation to the point where they return, guys, this is where we're going to look for our high probability trend trade. On a large chart, we're just using one bar. This bar right here tells me that the trend is up. This one bar tells me that the momentum is favorable. And you're going to see these tails or these wicks on these 13.2, these large chart bars. Guys, these tails are that refinement process. These tails are small retracements, little pushbacks against the trend, and this is where you are going to pinpoint your entries right at the bottom of these tails. And we're going to talk about how to do it. In a downtrend, it's the same thing. It's impossible to have odds favorable momentum. You can't have strong triggers in a downtrend unless the small triggers are below the large. And when they're wide, when they're angled in the direction of the trend, that space created between the two, the odds are favorable for this market to continue down. And then once again, there's those wicks with that odds favorable momentum. There's those tails. You're going to be able to pinpoint right where that tail is most likely to stop and go the other way. And that's going to be your entry for the high probability trend trade. So guys, this is rule number one. And I want to show you how easy it is to define. This is the S&P. Good morning, Safia. On my S&P in this picture, on my large chart, what direction is the trend? It's up, right? And then are the small triggers outside of the large triggers? We'll use this bar right here. Do you see how there's separation? It doesn't have to be a giant gap. But this one bar lets me know that I'm in an uptrend. This one bar lets me know that the momentum is up. Does that make sense, everybody? This is your first rule being met 100%. And what you're going to see is that the wider the space, the stronger the momentum. And the market pushes down. And then it weakens. And when the market weakens, when these trigger lines weaken, when the small triggers work their way back inside of the large triggers. This is a weakening of the large triggers. And anything can happen up or down. You'll see these weak triggers happen right before a reversal very often. You'll see these weak triggers happen at moments of indecisions when buyers and sellers begin to fight, when that momentum is taken away. And very often it precedes a reversal. So guys, strong triggers lead the way. Strong triggers are the advantage of they pushing the market like a freight train. It's most likely to continue. These weak triggers are anything can happen triggers. And guys, you're going to see it throughout the day. You're going to see strength turn into weak, and there's your reversal. And then strength, there's your tail for entry, turns into weak, and there's your reversal. And sometimes there's going to be indecision. And when there's indecision, we don't have to get caught in it. Because if the large are up and the smaller down, or the smaller down and the larger up, well, then I don't have odds favorable momentum. If my trend is up, but my trigger lines are red, I don't have odds favorable momentum. And guys, these moments of indecision happen a lot in between Fibonacci areas. But if you adhere to and commit to rule number one, that advantage of momentum, you're not going to get caught in these times, right? A lot of traders try to predict it. And I think that if we asked everybody to raise their hand who's ever been caught in a consolidating market, I'm pretty sure anybody that has any history with the market is going to raise their hand, right? It doesn't have to happen anymore because now you know that momentum leads the way. And without that momentum, we sit on our hands and we wait for the odds favorable momentum to come back. Guys, is everybody cool with momentum? Everybody's okay with the idea that when the small and the large separate in the direction of the trend wide, you have the advantage? Alan, you've been caught in consolidation. I know you have. We all have, guys. It's okay. So this is where I'm asking my new people. D-Rock, you cool with momentum? Atif, are you okay with the momentum? I know Safi is down with the momentum. Guys, this is a huge advantage. Embrace it. Once you have the advantage of momentum, we're going to make sure that we have the advantage of a clear path. And D-Rock, I'm going to answer your question as we talk about termination conditions. But I'm going to remind you, your large chart, ladies and gentlemen, defines direction, momentum, and areas. Your large chart is where we're going to look for these termination conditions. Your large chart fibs are where problems can happen. Your small chart, D-Rock, is an entry chart. Does that make sense? I'm looking for areas on the large chart. This is just an entry chart. So because they're two different charts, we're going to look for the advantage of a clear path on the large chart because the large chart leads the way always. And that's rule number two, making sure that we haven't reached an area that may stop the market because it's one of those likely to stop areas. It's one of those termination conditions. And guys, the areas that can act as a termination condition: blue Fibonacci support, red Fibonacci resistance, yellow one-to-one dots. It might be a magenta high line. It might be a cyan divergence low line. And then it could also be the large chart midband, but there's a condition for that. Your large triggers have to be a full bar away, and we'll show examples of this as we move through the day. And then there's one small chart termination that we look for, and that uses the loss of momentum, and we're going to get that too. But I want to talk about the areas first. On the large chart, we're going to define areas. Remember, the large chart is a slower chart. The looks won't be the same as on a small chart because the price bars are different. Your trigger lines, your momentum indicators are different than they are on the small chart. So we're going to use the large chart. And if price reaches an area on the large chart, if price reaches one of those fibs, those yellow one-to-ones, divergence highs and lows, that's the first piece of the puzzle, guys. Price must reach the area. Dynamic Renko bars have got to reach the area because Fibonacci areas are where price reacts. They're where the buyers and sellers make decisions. So if price reaches the area, none of the triggers have gone through the area. If they remain above support, support is behaving as a termination condition. You do not have a clear path. And it really is that simple. Price reaches the area. Where are your triggers? If they're above support, support is behaving as a termination condition. If price reaches resistance and your trigger lines are below resistance, resistance is behaving as a termination condition. So guys, let's keep it simple. Price reaches support. All of your trigger lines remain above. Support's a termination condition. Price reaches resistance. None of the trigger lines are capable of breaking. They peek their heads, but they don't break it. Resistance is a termination condition. Look how support holds to the tick and begins the move up. Resistance holds. Sometimes you get caught in consolidation. From support to resistance, you never have to get caught in consolidation again because now there's momentum as well as termination conditions. So when we talk about termination conditions, price reaches resistance, no triggers break through, no trade, it's not a clear path. It pulls all the way back to support, the trigger lines remain above support. There is no clear path. 90% of what you're doing is waiting for advantages. 90% of what you're doing is waiting for your indicators to tell you that it's time to look for a trade. Look how price, when it reaches Fibonacci support, when it gets down to that mid-band area, your large triggers are a full bar away. This is when your mid-band will behave as a termination condition. If there is room for a full bar, a full reversal bar to get back to those trigger lines, guys, price is likely to snap back to it. This is what we call the gap theory. When there is a giant gap between price and trigger lines, and price has reached support or a mid-band or one-to-ones or anything, divergence lows, it's likely to come back and close that gap. We don't look for short trades here. Price retests resistance. It reaches Fibonacci resistance, it reaches a divergence high line, it even reaches a second level of Fibonacci resistance. Guys, where are your trigger lines? They're below the area. If they're below the area, we're not looking for a long trade. Can it be that simple? Can you guys allow it to really be that simple? If price reaches an area and none of the trigger lines break through, it's okay to sit on your hands, to do nothing. And then we want a clear path. That's rule number 2. Make sure that we have the advantage of a clear path. This is the most simple approach that I know how to give you guys. If price reaches an area and the triggers don't break, sit on your hands and do nothing. We're waiting for a reaction. If both your small and your large triggers get to the other side of a Fibonacci area, that area is now broken. The path is now clear. It's time to look for those high probability trend trades. And look at this. There's odds favorable momentum, both triggers clear, and there's one of those potential tails. Guys, this is the easiest approach to termination conditions. Price reaches, no triggers through, no trade. Small and large break. We now have a clear path. And then, guys, there's one more. Strong triggers break things. Momentum moves the market. When your small triggers break through an area with that odds favorable momentum, this area has the potential to break. But because both small and large are not to the other side, it's still acting as a termination condition. It's not a clear path. Guys, these are the 3 options. These are the only 3 options that you can ever have at these areas. And I'm going to expand on my termination conditions for a minute because I took some pictures this morning and I made some stuff, and hopefully visually there's a little clarity that comes from this. So fibs are an area where decisions are made by the people that control the market, guys. Rule number 2 keeps you from getting caught in their decision-making processes. So there's 3 options that can happen when price reaches an area. Really strong triggers can break that area and the market continues through. This is the first option. But until the small and large get to the other side, we just don't know what's going to happen. Snorri, absolutely perfect. Guys, that's that gap theory that we're talking about. Price reaches a mid-band. Large triggers are more than a full bar away. Price is likely to close that gap right back to the large triggers, removing the advantage of any long trade until that happens. Sorry, digression there. The next thing that can happen, guys, is price reaches the area and then the buyers and sellers fight. Maybe the sellers are taking profits, maybe the buyers are entering positions, and maybe not everybody's on the same page. So you'll see that indecision right around key areas. You'll see that up and down. Guys, this is a horrible thing to get caught in. But rule number 2 keeps you from getting caught in that decision-making process, because when price reaches the area and the triggers don't break, you don't get caught up in this. And here's a picture that illustrates it. Price reaches the area. Look at the indecision on a smaller, faster chart. Look at the up and down on your large chart. There's a huge battle going on at this area, and there's no reason for Nexgen users to ever get caught in it. Or there's the final option. The sellers say, we're done. We reached a key area. The buyers take over and the market reverses. Guys, this is what's happening at those key Fibonacci areas. This is why rule number 2 is so important for us. Decisions being made at resistance, decisions being made at support. Nexgen users, You can take advantage with that odds favorable momentum, and right in the middle, this is where we get paid, guys. And we can identify where the market is likely to go through momentum, and we know where it's likely to stop because of trigger location. And next-gen users get paid at these key areas where the decision making happens. Support, the buyers take over. And they reach that key area of Fibonacci resistance, and look at the fight between buyers and sellers at these key areas. Ultimately, the buyers win. Guys, we never know if the buyers are going to win or if the sellers are going to win. And then we can identify the next key area for a fight. Next-gen users, we get paid in between these key areas. We get paid in between the decision-making points. And the further away from these danger areas, the easier trades become, the higher probability these trades become. So those of you that are learning termination conditions, does that help? Sometimes I create lessons and they're not helpful at all. But I think that if you identify that terminations are where people are making decisions, and there's no reason for us to be in the middle of that decision-making process because our vote doesn't count, guys, it's going to keep you out of a lot of problems. So price pulls through the decision area, pulls through those fibs, the triggers pull through. This isn't a termination condition, guys. This is just a pivot with a loss of momentum. This is a pivot, and we know that they're losing momentum. The sellers are losing the fight. The buyers have stolen their momentum in that blue cyan line. It prints from the bottom of that pivot, and it lets me know that they're losing momentum. But it doesn't print until about the third bar. When price comes back, remember the recipe. Price reaches an area. Where are my trigger lines? They remain above the area. Now it's a termination condition. And if this termination condition reverses the market, we're going to call it a strong bottom, guys. And that strong bottom, that termination that creates a full reversal, that is the precursor for the highest probability trend trade that you can take. We call this a pivot stop out of a divergence low. Here's your pivot. This is where all of the sellers get stopped out and the buyers take over. You see the same thing from highs. Here's your pivot. It happens to coincide with Fibonacci resistance. Here's your pivot stop out of a divergence high with resistance, which just adds power to the top. And if a termination creates a full reversal, we call it a strong top. And if that strong top gives us odds favorable momentum and a clear path, guys, there's one of those tails. There's your highest probability trend trade to the short side. And when they happen after a termination that creates a full reversal, they tend to run just a little bit further. Price reaches one-to-ones. Where are my trigger lines? They all remain above. And since they remain above, no short trades. This is where buyers and sellers are making decisions. You can see that the buyers wanted it to go up, but the sellers weren't done and they pushed back. And there's that fight that you'll never get caught in if you're waiting on momentum, if you're waiting on the advantage of a clear path. Ultimately, this termination condition reverses the market. Large triggers go from red to green. It gives us odds favorable momentum, and both small and large are above resistance. And there's one of those tails, one of those highest probability trend trades. Guys, we knew about this red fib all the way back at 8:38 a.m., right? And even before. And that red fib off in the distance became a target. It became the area where the market is likely to go. Next-gen users, you're learning how to take advantage of the moves in between decision-making points. And then sometimes, and this is the last termination condition that I'm going to talk about, but I'm going to ask before I do, is everybody okay with using the large chart to define your areas? Is everybody okay with the simple recipe? Price reaches an area. If no trigger lines have broken through that area, sit on your hands and do nothing, guys. You don't have to be first. You don't have to predict. NextGen's rules are designed to give you clear-cut advantages visually so that you never get caught in these fights between buyers and sellers. Sometimes the buyers take over from the middle of nowhere, and sometimes the sellers take over from the middle of nowhere. This final, absolutely, D-Rock, areas are defined on the large chart. Areas define termination conditions, so I can only have a good top or bottom if a termination condition creates a full reversal on the large chart. So here the market reverses, right? It goes from red to green. It gives you odds favorable momentum. There's one of those tails. This may be a beautiful trade. It's just not coming from a good bottom. It's only coming from a pivot in the middle of nowhere. And the same thing up here. Price doesn't reach the fib. The momentum is favorable, but the market pushes down. This is the only termination condition I'm going to respect on a small chart, guys, and it's going to help you identify what the large chart is when the large chart's changing, because you can't see it on a large chart. It's too slow. It's a broad stroke of a brush. Three divergences, three losses of momentum. That's all a divergence is. It's a loss of momentum. Three divergences in the same price range may terminate the trend. So what we're seeing visually is 1, 2, 3 cyan lines form, meaning that the market has lost momentum 3 times. And I'm going to give a visual of what this means real quick. I used to do this in a 101 class. This white arrow represents price, right? And price pushes to the first pivot, price pushes to the second pivot, price pushes to the third pivot. Price bars represent price. I'm going to change the color to yellow. This yellow bar represents momentum. And when divergence is true, momentum is not following price. And this becomes a key indicator that the buyers are starting to fight back. Three divergences in the same price range means that 3 times in a row price lost momentum. This may reverse the market. This becomes even more powerful when your small triggers work their way inside of the large triggers. When you get those anything can happen triggers. So visually, you're seeing 3 losses of momentum. Visually, you're beginning to see weakening trigger lines on your smaller, faster chart. Guys, this can push the market the other direction for a little. It's still 3 divergences is 3 divergences, D-Rock. So let's do this. Your first termination condition. I like that you asked that question. Is 3 divergence. Cool? Your second termination condition, and it's a little bit stronger, is 3 divergence plus weak triggers. Both are still termination conditions, but one carries a little more weight. And then your third one, which is just a little more powerful, is 3 divergences, and the final pivot is higher from a low or lower from high. And that becomes a head and shoulders pattern. So on its own, 3 divergences can turn the market, guys. When I couple that with weak triggers, it becomes more powerful. And then when I triple up and I get that higher pivot from a low or a lower pivot from a high, it becomes more powerful still. Guys, you're going to see these 3 divergences on your smaller, faster chart at a low, at a high. When your larger chart may be seeming to turn from the middle of nowhere. So this becomes a great opportunity for you to avoid that last short trade or avoid that long trade with the odds favorable momentum and the clear path because your small chart is showing you the change that's happening. The other thing that these divergences are going to do for you is they're going to allow you to manage trades. If you're in the perfect short, if you have momentum, if the path is clear, and you end up with 3 divergences, you may be able to manage out with small profits, avoid taking losses, avoid the idea of hope, and it's going to help you out. And Sean, I see the black name next to you, and I just want to remind you that I will look at everybody's pictures and respond to them in the second hour after we discuss rules, so that I can work the advantages into them, so that I can talk about the rules that help. Um, and then I'm going to remind you guys when you post charts, I need to see both of your charts. It makes it so much easier, unless you just have a small chart question, in which case I'd be happy to do it. So like if I look at your chart right now, Sean, it becomes difficult, right? 3 direction changes doesn't mean sit on your hands. It just means that the market's fluctuating, and this is a smaller, faster chart. So all of this may be happening in just one bar, and we'll relate everything back to the rules, right? You may have momentum on your large chart. You may have a clear path on your large chart, But jumping in up here is rarely a good idea because the market loves to come back to areas of support inside of favorable large triggers. And that's what we're going to talk about right now, is pinpointing where the market is most likely to continue. And I'm going to ask the room one more time, guys. I'm insecure. I need reassurance. Is everybody comfortable with the idea of momentum? Strong triggers on that large chart? Cool. Is everybody all right with the idea that for termination conditions, if price reaches the area and the triggers don't break through it, it's okay to sit on your hands and do nothing? Awesome. So guys, when those are true on the large chart, let's pinpoint where the market's likely to continue. What do you say? Let's find that best of the best entry, that highest probability entry. And remember, that's going to happen on your small chart, your refinement chart. What happens in one bar on your large chart is going to happen in 15 to 30 bars on your smaller, faster chart. I'm going to show a picture of that refinement process real quick. I've got so many pictures, guys. You should too. One bar on the large chart defines direction. One bar on the large chart defines momentum. One bar on the large chart defines your areas. We're going to refine now, and we're going to use a limit order to buy or sell a pullback, which means that when everything says down, we're going to let the market come up. Or if everything says up, we're going to let the market pull down. And we're going to let it pull back to an area, fibs, mid-bands, yellow 1-to-1s, inside of favorable large triggers. And by using the smaller, faster chart to refine that large chart, we're going to be able to pinpoint right where the market is likely to continue. It's going to allow us to reduce our risk. It's going to allow us to maximize our profit potential. And see how that tail on your large chart is the top of that pullback right at an area inside of favorable large triggers. Guys, we don't trade the tails, but we sure can predict where they're going to happen. So we're going to do that with rule number 3, guys. We're going to use a limit order to buy or sell a pullback at an area inside of favorable large triggers. So the first thing that I always want to define with you guys is favorable large triggers. What's it mean to have favorable large triggers? It means that your large triggers on your smaller, faster chart, which are these smooth triggers, and your synthetic triggers on your smaller, faster chart, which are these stepped kind of 90-degree triggers. And all these synthetic triggers are, guys, is your large triggers from your large chart. That's it. But what Nexgen has found through decades of research, so you don't have to, is that when your large triggers and your synthetic triggers are one on top of the other, when they are wide, when they're angled in the direction of the trend, the areas inside of them are the most likely point for a bounce. The areas inside of them are where the market is most likely to continue. And the tighter they are one on top of the other, the smaller that window becomes, which means that the risk that you put on a trade decreases dramatically. So when everything says up on your large chart, the path is clear on your large chart. This is an uptrend, right? This is the look on your small chart. You can have strong triggers. Small should be above the large. Verify that momentum. You're looking at your large and your synthetics. Good morning, Miss Debbie. Are they wide? Are they open? Are they angled in the direction of the trend? Are they one on top of the other? And then our rules say that we're going to buy a pullback at an area inside of those favorable large triggers. And the areas can be blue Fibonacci support. If it's a long trade, your mid-band more often than not is green, because if price is above the mid-band, it's green. Or we can use yellow 1-to-1. So fibs, mid-bands, yellow 1-to-1s for a long trade. Fibs, mid-bands, yellow 1-to-1s for a short trade. We're going to define the area where the market is most likely to continue when the pullback begins, when that small retracement counter to the underlying trend, that little pullback in price, that small crowd fighting the large crowd. It begins with a reversal bar. Still a good trade if the synthetics are far from the 5-1. It increases your risk dramatically. I'll show you how that works too, Drock. Let me get through this. Let me get through entries, and I've got the perfect picture for you. You're asking absolute rock star questions today. But let's get through the entry. And then what I'm going to do is I'm going to cover the one on small chart. We're not looking for areas on the small chart, right? Defining them. Did we cover that question? Did that answer it okay for you? Okay. Because I love areas on my small chart because they may give the small chart a bounce back to my entry. Um, this reversal bar signifies the beginning of a pullback, guys. You're going to create a window of opportunity, an area where the market is most likely to continue. For a long trade, it's from your highest point of support to your lowest point of support inside of favorable large triggers. For a short trade, it's your lowest point of resistance to your highest point of resistance inside of favorable large triggers. Embrace that phrase, inside of favorable large triggers. So from this mid band to these yellow one-to-ones, this is where the market is most likely to continue because of the momentum on the large chart. Because there's nothing in the way on the large chart to create a bounce, you're going to enter the market at the highest point of support inside of favorable large triggers. And let me show you, and let's talk about the whys, guys. I'm a big fan of whys. Why do we get in at the highest point? Because when the momentum is this strong, when there's absolutely nothing to bang your head on, I'm not expecting this pullback. This is NASDAQ this morning. I'm not expecting this pullback to get too terribly deep because there's nothing in the way and it's a freight train of emotion zooming to the top. So your limit order goes right at the top. You have defined your window of opportunity. You've looked inside of favorable large triggers and you've created a window from your highest point of support to your lowest point of support. Is everybody comfortable with this so far? Especially my new people. Everything on the small chart begins with the reversal bar. At the time of the reversal bar, I look for my favorable large triggers. That's this yellow box. And then I refine that bigger area to a smaller area from the highest point of support to the lowest point of support. So far, so good, everybody? Because at this point, you're powerless. The market's going to pull back, and if it reaches that highest point of support, if it hits your limit order, you're in a trade, guys. You're in a long position. And here's the best part, is you're in a long position with the advantage of momentum defined by strong trigger lines on your large chart. You are in a long position because there are no termination conditions, no areas where the market is likely to reverse as defined by your large chart. And now you're in the area or in the trade at the point where the market is most likely to continue, defined by the areas inside of favorable large triggers on your small chart. This trade revolves around advantages. Your entry is dependent on the advantages being true. And we're in at the top because of the momentum. But guys, here's where trading is going to be emotionally taxing on you. It may push to the bottom of the window, right? It's a window, it's an area. And D-Rock, the wider these triggers are apart, the bigger that window becomes, the greater the risk becomes. We manage our risk before we ever manage our profits, guys. And we can identify where the market shouldn't go by having a stop outside of those synthetics, outside of those large triggers, to where if the market continues through, whoops, if that market blows through the highest point, right? Blows through the fib, blows through the next fib, blows through the one-to-ones because the sellers had something up their sleeve, we have a protective stop waiting outside of the window of opportunity, right where the market shouldn't go. And I'm going to tell you guys, anything that wins 70 to 80% of the time is mathematically obligated to take a loser 20 to 30% of the time. The market is wrong, right? Because we're not. The market is wrong. Guys, this is a normal part of a positive equity curve. You will take losses. If you believe that you will not take losses, you're fooling yourself. But here's the deal. You're going to spend 20 days taking great entries, 20 days building trust, so that if you have odds favorable momentum, if you have a clear path, if you have an entry area, you know that you had a statistical advantage. So focus on execution, not results, because the results should be there. And sometimes you can have four in a row, right? So D-Rock, if you take 100 of these trades, you're going to lose 20 to 30, right? If you take 10, you're probably going to lose two or three. The sad part is we don't get to pick which two or three. We never know. So we protect our investment with a stop. Some common things for new users. Has anybody ever heard about the fear of missing out? The small chart is a refinement tool. One bar defines momentum. One bar defines your areas, right? This is going to have fluctuations. And if you get worrisome and jump in at the top of this move, well, your stop still has to go below the window. You didn't do anything other than guarantee a bigger loser if it's one of those 20 to 30%. But what you've also done is you have killed your ability to make profits. You have to sit through the headaches of potentially larger loser, and you just don't have any room back to your target. So guys, your first 20 days with Nexgen is designed to build trust in entries, to learn to get into the market at the absolute best of the best spot. And I'm going to tell you right now that when you go back and study these, when you circle those tails and they show up at the areas, and you see how often they win, um, and you see how the advantages play out, you're going to be in the same boat that I'm in, guys. I don't miss this trade. This is a trade that I will take hell or high water, and I couldn't care less about the result because I have over 7,000 pictures in my database that tell me that this wins more than it loses. It creates a statistical advantage. And the cool thing is once it starts to move in the direction of the trade, I can reduce my risk below this reversal bar. I can further protect my investment. And because Fibonacci was up there the whole time, I knew where the market was likely to go, and it becomes a great place to take profits. And guys, this is your high probability trend trade, and it revolves 100% around having those three distinct advantages. Three advantages creating a trade. So everything that I talk about when I look at your charts are going to go back to these three advantages. If you take a trade, I need you to write your rules on the chart, because if it's not a high probability trend trade, I'm going to critique it as though it were, right? Because that's what we're doing here. If you take a trade that is outside of the high probability trend trade, I will still relate these three advantages to it, because this is an educational room and I want to make sure that my new users always get an idea of the advantages being present or not present. And then I'm going to remind you guys that trading is an individual sport. What I do may not be what D-Rock does, and what D-Rock does may not be what Ron does, and what Ron does may not be what Alex does. And that's okay, because nobody's paying each other's bills here. You have to develop a plan that's right for you. But if you allow that plan to begin with high probability trend trades, if you give yourself a checklist, or even better, if I give you a checklist that you can print out and put on your desktop, and you can police yourself and know exactly what to write on that chart, guys, this is your foundation. This is your basis for becoming a chart reader. I've never had anybody stick just to this plan and do worse than 70%, but I'm going to tell you right now, it's boring. Being a successful trader is boring because it means that 90% of the time you're waiting for a statistical advantage. If you're taking 30, 40, 50 trades a day, you're probably not following a plan, you're probably not following rules, and you're probably pretty inconsistent, and your results typically show it, guys. Focus on the best of the best. This defines your entry. And then I've got this exact same checklist. That one should be printed out and put on your desk. Guys, here's the exact same checklist that liberates pictures from the resource material to show you exactly what a good bottom looks like, or a good top. It's a termination that creates a full reversal. It shows you exactly what odds favorable momentum looks like, and it reminds you that anything can happen when those triggers weaken. It talks about the recipe for a clear path, whether you have it or whether you don't. And it gives you very detailed instructions on how to create your window of opportunity, the area where the market is most likely to continue. Guys, this should be reviewed every day because you're only spending 20 days looking for entries. Entries are the first part of what you do. And let me show the path picture before I show the plan picture. D-Rock, it depends on the day. It really does. So before I ever walked into this classroom, guys, I'm already over my goal for the day. I don't have to trade this afternoon. I'm done. That was before the market even opened. And then there's other days where those fights are huge and they don't give you the clear path, right? Or they don't give you the odds favorable momentum. And it's rare that I've ever sat through an entire day without a trade, but I'm going to tell you right now, when the market isn't giving it away, it's important that you really embrace the idea of having those rules and those advantages because you're not in control, guys. You're only taking advantage of what they're creating. I wanted to share this picture with you for my new users. This is step one in becoming a confident day trader. This is step one in putting yourself in a position to be on that path to success. And it's understanding entries. And I don't know if you guys saw my bunny picture before. Um, I'm going to post it one more time. The bunny picture reminds you that it's a path, that it's step by step, right? I don't want to draw a rabbit. I want to learn the process to draw a rabbit. I'm not going to just be a day trader. I'm going to learn the process to become a successful day trader. And it begins with trend. Understanding what direction the market is moving and then committing to trade with it. And then once you've identified trend, you're going to make sure that you have strong triggers. This is step number two. This is the mental path that I go through each and every trade. What is my trend? Do I have strong triggers? Most of you are going to be able to identify strong triggers in the first day, second day, right? And then I'm looking for those termination conditions. And guys, sometimes this takes a little longer. I was very stubborn with termination conditions. And even though I saw them, I traded into them anyway. And it took me a while to realize that I didn't want to do that. But that's the third piece of the puzzle. And then once you have trend and momentum and a clear path, you're identifying your entry, guys, and all you're doing is getting in at the best of the best spot. And that's your goal for 20 days is great entries. And your goal should also be to post every one of those great entries and not worry about the result. Focus on the process that gets you in at the best of the best spot because that's what creates manageable trades. So I created for the new user. I created for the brand new user, for the D-Rocks, for the Atifs, for the Big Ls, for the Chris Ls, right? And if I missed you, I apologize for the Snorries. I created a plan that is a simple plan for consistency as you learn to read your charts. But here's the giant disclaimer, because people hate to think that they're going to be shackled to one thing, right? This plan is a stepping stone in your learning journey. It's designed to optimize your chances of winning with the high probability trend trade or the 50-50 trade as a new user. And the 50-50 trade is when those areas have the potential to break. But through simulation, through study, through class feedback, and continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Be mechanical. Be mechanical. I'm going to cover that right now, D-Rock. You are so in my head today. You're like 5 minutes ahead of me on every question, which I absolutely love. Your first thing for simplicity, don't fight the large chart direction. Don't fight the large chart momentum. Guys, this will eliminate 70% of new user problems. I've seen it. And then define your entry. Notice that it says define your entry. I'm not defining my trade. I'm not defining my targets. All I'm doing is using a mechanical approach to determine whether or not I'm going to enter the market. If the rules are met, if the advantages are present, I'm going to get in the market. And guys, that's what the path is. The path for the first 30 days is getting into the market. And then D-Rock, the same way a mechanical approach to getting into the market, that pragmatic, that opinionless, emotionless way getting in, either the rules are met or they're not, we're going to be able to apply the exact same thing to the management initially. Because remember, you're learning to write, or you're learning to read your charts. You're learning to understand what the market's telling you. So everything begins with a great entry. Everything begins with selling the market on its way up at an area inside of favorable large triggers. Everything begins with buying the market on its way down at an area inside of favorable large triggers. And once you have this, you can identify where the market shouldn't go beyond those areas, guys. Your typical risk going into a futures trade is going to be 12 to 14 ticks, approximately $100 to $140, depending on the market. This entry is the best of the best. And at this point, there's nothing for me to do. My stop is where the market shouldn't go. And I'm either going to get stopped out, I'm going to take that loss, the market is wrong, it's part of my 20%, it's a cost of doing business, whatever makes you feel good about taking that small loss because it's a normal part of a positive equity curve. Or the market blesses me with a reversal bar and it says, hey Mark, with the downward momentum, with nothing in the way, with you having taken the best entry, we're going to go ahead and start moving in the direction of the trend. And at this point, I'm going to reduce my risk. I'm going to go 2 ticks above that. 1 tick above it, 3 ticks above it, guys. Pick what's best for you. And at this point, I'm not going to do anything. I'm not going to insert my emotions, and I'm not going to fulfill hope expectations. I'm simply going to say it's either going to hit my stop, my risk is reduced, it's a tiny little loser, everything's cool if it loses, or it's going to hit my first target. And these are my only options, guys, and I'm sitting on my hands and I'm 6 feet away from my mouse. And if it hits my first target, it's $100, guys. This $100 drives people that think everything needs to be a home run nuts. This is $100. This is $100 in your pocket that nobody can take from you. This is $100 that makes you feel successful. This is $100 that brings elation, serotonin, dopamine. This is $100 that means you're a winner, and now you have confidence in the memory of success. This is based on 2 contracts. So we're looking at $100 for the first target. It's easy to get to when the advantages are present. And now our stop is break even. So now I have nothing to lose. Not only do I feel successful and confident, but I have absolutely nothing to lose. And guys, this isn't designed because we're scared of the market. This isn't designed because it's even a good decision for somebody that's capable of reading their charts. This is designed to keep you relaxed. You've been paid with nothing to lose, to let the market do what the market typically does, continue in the direction of the trend, advance forward with that odds favorable momentum, and make it to the next key Fibonacci area like it does more often than not, guys. So you're either stopped out break even or it hits that second target. And guys, we jump ship at $200 as a brand new user, as a mechanical, pragmatic management approach to your trading. At $200, you're out of the trade. You traded a 2-lot. There's $300 in the bank. And you feel great and you have confidence, right? And now you're just going to wait for the next setup. Guys, this is not the end of your management plan. This is the most remedial, basic, leave 1,000 pounds of meat on the table kind of management plan that you're ever going to trade. But what it does is it takes the emotion out of it. It takes the decision making out of it. Everything is if then. And then as you grow through simulation, study, class feedback, and continuous practice, just like your trading plan will evolve, so will your management plan. So the idea is that you stay mechanical at first, right? You stay pragmatic at first. You don't worry about home runs. You look to make money. And when the market says down and the momentum is its strongest and it pulls back to resistance inside of favorable large triggers, guys, let's look at it real quick. If your entry was 1175, your first target was at 975. Your second target was at 775. Did I do that wrong? 1175, sorry, 975. That's down here. But check it out, guys. Not only did you get into the best of the best spot, your risk was 6 ticks once that reversal bar printed. Your first target was hit on the 3rd bar down. You went break even with nothing to lose, and on this trade, you hit your second target. And at this point, who cares what happens next? And as you grow, this target is probably going to move down to that blue fib. Give me a Y if you see it. Guys, this is the S&P showing you how you're going to make money on the high probability trend trade. And it really can be that easy. And momentum says we're going. This is right now. This is live, PFI. This is the live market doing its thing. If you're pragmatic, guys, you already made $300. And then D-Rock, when you learn how to trust momentum and direction, that $200 grows. Does that make sense? And there's your target reached, guys. Down at 650. From 1175 to 650. You go from 200 to maybe 300. Did you guys hear how calm I was? Did you guys hear? It's okay how pragmatic it was. D-Rock, your entry was at resistance inside of favorable large triggers. Your window of opportunity was right here. There's your reversal bar. There's your lowest point of resistance. There's your highest point of resistance. This is the area where the market is likely to continue. Your initial stop goes where it shouldn't. And that's okay, Jose. Right around 1150, 1175. And Jose, we're coming from a good top in a secondary, right? And we have strong triggers and the window is small. And this is the S&P. Jose, I'll take this one all day long. Safia, I hope everything works out. Safia, I had to rebuild. Um, are you still there, Safia? I had to go through, and maybe this will help you. I had the problem the other day. Are you still here? Did she split? Guys, she left, I think. Guys, I couldn't keep my NinjaTrader 8 open one day. It like wouldn't even load. So I went to my workspaces and something was corrupt inside of my NASDAQ workspace. So I just deleted it. And then when I rebuilt it, I was good to go for the duration. But guys, that's it. Jose, do you see how it was a good top? They seconded the good top from resistance. And look at the distance from the fib. Look at how far the triggers are through. Look at the momentum. And guys, this is why I gave that decision-making talk earlier. The further away from these fight points, the easier trades become, right, Jose? So if the triggers are barely through, that's tough. It is. But look at where the bottom of the bar is, guys. The next one didn't make the area. This area has the potential to break, right? Guys, I want you to start thinking about what fibs mean. I would enter on the pullback to resistance inside of favorable large triggers. So, great question, E. So this goes back to our window of opportunity question. What is the window of opportunity? I'm looking inside of triggers, right? So my first area that I'm looking at from the top of the triggers to the bottom of the triggers. Does that make sense? You were waiting for a mid-band, right? Your window of opportunity, E, extends from the lowest point of resistance inside of favorable large triggers to the highest point of resistance inside of favorable large triggers. So your window of opportunity isn't just a mid-band, Your window of opportunity extends from Fibonacci resistance all the way to those yellow 1-to-1s. Does that make sense, everybody? You don't. You don't have to chase anything, PFI. You have to put a limit order at the bottom of the window. And you have to catch the trade. And if you're on the phone, you have to realize that life happens and you're not going to catch every trade. They're the exact same time, Sean. 100%. They are 100% in sync. Here's your most current price, but they're different size. They're different sizes. This is a slower chart. This is a broad stroke of a brush. So Sean, what happens in one bar? Watch this. Let me get this off of here. Let me remove all my drawing objects. I want you to see something. Sean, this is why we use two charts. I don't know anything about bar counts. I'm not going to lie. I know nothing about them. But see how if I circle the bar that gives me all the great information, inside of that square, sorry, are all of these bars. And so that's the refinement process. So they're the same market, the same everything. It's just, yeah, it's a larger, slower chart. So we let the large chart, oh, no worries. Direction's easy. Direction is easy. If the background is red, Sean, we're in a downtrend. We're only looking for rules to be met for short trades. If the background is green, we're in an uptrend. We're only looking for rules to be met for long trades. Does that make sense, Sean? That's the first key, is just trading with the trend. The next thing that we look for on the large chart is momentum. Yeah, cool. So now I know that that my trend is down, so now I'm making sure that my smalls are outside of my large, which they are, so I have momentum. And then I'm looking to make sure that I haven't reached that key area, and I haven't. So now I'm looking for those areas inside. This is where I refine. That's the refinement process that gets me to pinpoint that area where the market is likely to continue. So the two come together. And guys, the reason we define areas on the large chart and not the small chart is because your small chart may have, let me see if I can find an example of it. Let's see if we can find a perfect entry, or at least a good entry that's bouncing off of something. 849. Um, 45.16. So, D-Rock, are you with me? Guys, I want you to see this look right here. This looks like a termination condition, doesn't it? No triggers through resistance. Gosh, that's ugly. But on that larger chart, those small triggers are smashing through. Because it's a different time frame, because the moving averages work differently with the time frame and the bar structure, a lot of times, D-Rock, you can see that 50-50, that great looking trade here, but it might look like a termination condition on a smaller chart, which is why we let the large chart define the areas. Does that make sense? So even though it's the same fib, right, we use the trigger lines on the large one. And I was looking for an example on this one, so that definitely helps, right? So, cool. Guys, that's your high probability trend trade. Here I have weakening triggers, but I do have a clear path, but I don't have any areas inside of favorable large triggers, and look how they're weakening here as well. Give me a Y if you see it. A lot of you wanted to go short at this midband, but if you did, what were you forfeiting? This is how I'm going to look at what you guys do. Whoops, wrong one. Sorry. If I took this short at the mid-band, guys, I forfeited momentum. I also forfeited an entry area. So I want you new users to embrace the idea that it's the three that create a trade. And I personally, in my trading plan, I don't give up two of these ever because then it goes into a low probability scenario. Then it's really just me trading hope. And E, you said you were only using the one large trigger? No worries. You watch 30 days of videos and you miss this one key lesson for entry. Let them work together. It's the areas that are inside. But when they overlap, they create favorable. And D-Rock, that probably goes back to the question that you had of when they're further apart. They're barely overlapping here, right? And do you see how much bigger your window is? And then on that same token, the difference between, and guys, I fill my spreadsheet. I hope that you do. Let me show you split triggers. I've got one here labeled split triggers. And that's actually the picture that favorable large triggers comes from. And this was a lesson in the class, right? So when they're one on top of the other, that window becomes easy, easy. Whoa. That's so big. Too big. Um, and then D-Rock, where it's coming down here, at the time of the reversal bar, and let me show this picture because I think this is a good one. And guys, this will help you. Why we focus on those. If I'm looking from the top of my triggers to the bottom of my triggers with a call out box instead of a shape, at the time of the reversal bar, check this out. I'm looking at one-to-ones in a mid-band, right? And the reality is it can go to the area inside, but it can also go to the area down at the synthetics. So look at how big that risk becomes when they separate. And I'm not going to lie to you guys. There will be times where you are totally okay taking this entry, D-Rock. When it's coming from like a crazy strong bottom and everything is just freaking amazing, you might be willing to risk it. But this also visually brings the gap theory into effect, saying that price likes to close back to the large triggers if they're too far away, and you'll see that a lot. So that's one of those reasons why I teach favorable large triggers, because it just reduces the risk, guys, and there's no reason to take ginormous risk on these trades. We're too good at what we do. I didn't, Chef. I'll catch it. I'm just finishing up all the lessons on rules. I'm going to take 5 minutes and stretch my legs. And then I'm going to come back. And we're going to start looking at all your charts, guys. And we're going to look at the live market. And we're going to look at all the examples coming. This is one of those areas with the potential to break right now, guys. The small triggers are through. The large triggers are not. But we're not coming from a termination that creates a full reversal. And notice how there's no areas inside of the triggers. Patience is a virtue. Patience is gonna yield dividends for you guys. So I'm gonna take 5 minutes. I'm gonna stretch my legs. Guys, do the same. Go stretch your legs. Go relax for a second. Stop looking at your monitor for 5 minutes, 4 minutes. And then when I come back, we're going to start looking at all the pictures. We're going to talk about how they relate to advantages. If you have questions about any of the concepts for the high probability trend trade, I want you to take a picture of your chart and I want you to write the question on a picture. That's what I'm looking for. And then, guys, I'll be back in 5. Mike silence for about 5 minutes. second half of class. I used to break it into 3 hours, but now I'm just going to break it into like 1.5 each because I think it's important to cover all those basic foundational things. So I'm going to scroll up to the top of the room right now. Whoops, sorry. Thank you for that. Let's see. There we go. Standing in the bathroom anymore. All right, guys. I scroll up to the top of the chat box when I start looking at your pictures. So, if you ask a question down at the bottom, sometimes it takes me a second to get to it. So if it does take me a second, I apologize. I'm not ignoring you. Let's see what we did. Getting up there. I think I was busier than most people this morning. I did post in those pictures about termination conditions and what they mean. Um, Ron had some great wisdom in there about the way to learn it is to immerse in it, to live it. And it's hard to do it part-time, guys. Give it everything you have. You got to work or you're not going to get there. And then, man, we have. All right, Ron got us started. Ron was playing on Sim during. Oh, there it is. During whatchamacallit, during news. So he put a Monopoly board up there because he's not willing to put real money on it. All right, Jose got us going. Close that. Stop. All right. So it's a 50-50 trade coming from a weak bottom. And this is crude oil. And you didn't take it because of the weak bottom and the largest chart showing possible termination with the triggers. This is awesome. And then Jose, let's go through one more thing. Let's expand one more on this one. Because this is a great example of those split triggers as well. And I want to show this. So if we look at the risk on this trade, from 89.30 and the bottom is 89.19, right? So it means that your stop is about $150 per contract. And your stop is $150 per contract on a couple different things. Let me jump down to the bottom so that we get the feedback on this one. Check it out. Couple different things. The large triggers were a full bar away. We can see that with the large triggers way down here. But your window of opportunity is huge. The areas haven't broken, right? The large haven't even made it up to them yet. And they barely cleared the one below. I think avoiding this trade was an awesome choice on your part. There's too much risk on a maybe trade, right? There's too much risk on a trade where you're hoping that an area breaks. There's too much risk on a trade where there's such a large gap back to the large triggers. And guys, sometimes you have to be okay not taking a trade because the risk doesn't justify it, right? Especially on a medium probability trade, on a trade where maybe the area may not even break. So I think that was a great decision. And then there is that odds favorable momentum. There's a full gap back. This is the exact same trade. Joel, where are your synthetic triggers, my friend? See how the larger a full bar away? Your synthetics would have been well down here. Um, and you're not printing synthetics on this chart at all, and you would have seen it as a 50-50, I believe, had you. You're missing some indicators. Gary reminding us that at 9:30, that's Australian, Gary. I'm gonna jump down to the bottom real quick. So Gary, maybe you did a refresh on your computer. Are you in here, guys? I want to share this. Gary, you're looking at Great Britain, you're looking at Japan, you're looking at Australia. Guys, you don't need all that stuff. We're trading American markets here. If you're trading the yen, maybe Japanese news is important, right? If you're trading the Australian dollar, maybe Australian news is important. Guys, when you go to forexfactory.com, filter out all those other countries. Who cares what's going on in New Zealand? I don't, right? Keep it US. It's going to help because you might have missed a beautiful trade at 9:30 a.m. because you were worried about what the Australians were doing. It's kind of like if I'm sitting in McDonald's eating a cheeseburger, I don't care if somebody's Whopper's wrong over at Burger King. It just doesn't affect me. You see where I'm at here. Dun dun dun. Next one coming up. Here we go. Ron. Ron says momentum is a good thing. I am very inclined to agree. I sure will, George. Give me a second and I will. Let me go through a couple. And it's the gap theory. Are we talking about the synthetic for entries, George, or are we talking about on your large chart for the snapback? Awesome. Let me get this picture to post up. This was Ron's, but Ron's chart's being lazy. But I'll be happy to, George. Let me go through a couple pictures and get closer to the bottom of the list here. And then we'll talk about that one. I'll do a full lesson on it. I appreciate the question. Ron, yours isn't loading, my friend, but I can tell you what it was, everybody. It was odds favorable momentum, and it was a clear path, and it was an entry taking advantage of both from a chart read. But for whatever reason, it's not coming up, Ron. I'm going to try and click on the next link and see if it's me or if it's something going on. Jose, Joel. One of the things that happens when I scroll down to the bottom, guys, is I have to scroll back up and sometimes I lose my spot. So if it feels like it's taken me too long, that's why I'm trying to figure out where I was. And then, George, here's your first part of the lesson. Snorri, I can't tell you how convenient this picture was on two different fronts. So on your large chart, George, if price pulls away from those large triggers fast, 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 and reaches a mid-band or one-to-ones or fibs, if these large triggers, in this case, are below the reversal bar marker, that means that there's room for a full bar plus before price ever gets back. So this is the gap theory. Price is likely to snap back and hit those large triggers. So that's the first one, using it on the large chart. And we can go through a couple more examples. And then Sean, three directions, both hands. Oh, see, I like this, Sean, because let's go through the two pictures. And then Sean, are you with me in here? Cool. So Sean, remember when you showed me this picture where you had gone, I'm assuming long, and I said we're going to talk about how to refine that, right? Look what the market did. It pulled right back to support right at those large triggers with all that momentum. That's okay. You're going to make a million of them. But isn't that cool how you get to see it kind of real time? It did exactly what we anticipated. And it just kind of confirmed the idea that if you sit on your hands, if you're a little patient, if you don't get nervous, it does what it does. The market does what it does. And don't get caught up in all of these little pivots. These little pivots will drive you absolutely nuts. Make sure that you have momentum, right? Make sure that the triggers are strong, that they're through the areas, breaking through the areas, and then just look for your entry. Keep it simple, man. You're focusing on that small chart. That happens. It's okay. How long have you been with us, Sean? I notice that you still have demo on the name. Just remember that it's a process. You're on day 6. Cool. So you're getting to that point where you know which direction you should be going, right? You know when it's time to start looking for a trade. And now we're just going to refine that entry. We're going to focus on that entry. And this is one of those opportunities, man. That's 300 in the bank. Easy peasy. So great pictures, man. Thank you for sharing those. And that was just great. I love that you showed me both of those today because it shows what new users tend to do. And then it shows the result when it's done correctly, when you keep it simple. So rock star, dude. Nice work. All right, PFI. Termination. Large chart says up. Large chart's coming off of termination. Three divergences. You say three divergences in the trend, but you got out on two with everything saying up. So you sold at 2150 and you had a 7-tick stop. And then you jumped out for a tick. PFI. Research trade on sim. All right. I like that it's researches. So I don't care about the winner. If you fight this momentum, if you fight this direction, and you jump in when every one of your charts says up, you got lucky. That's it. You got lucky, and you didn't see three divergences. You saw two divergences, and you hoped it went down. Do you see the difference? You saw an uptrend, and you hoped that it would go down. You saw smalls above the large, and you hoped it would go down. You said small triggers up. You saw a mid-band hold. You saw large and synthetic up, right? No, you didn't. Because there's your second. I don't know what bullish and bearish means. I don't know which direction those are. But there's your second divergence to the upside. And then you let 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 bars print. 14 bars in the direction of your trade. Okay. But do you see how a couple different things. One, you're trading hope, and that's cool. Whatever. You're doing it on research. You're practicing the wrong trades on sim and building muscle memory. You're fighting the direction. You're fighting every trigger. You're not trading from areas in the direction, right? And you're annotating your chart. And your annotations. Yeah, but we're on this one. Guys, if you post it in the room, you're up for critique. Always. But you wrote three divergences and it only had two. So you said 2 to 3 divergences ends the trend. Is that real? Is that PFI's rule? Or so I'm my only point here, and I love that you're researching on sim, and let me say that because this is how plans get made. This is how plans happen, guys. When you get on simulator and you screw everything up. Um, And I'm not saying that that's what you did, but when you're doing research, it's imperative that your annotation is true. That your annotation is what actually happened, not what you hoped happened, because that's how plans get built, right? You need that concrete, solid, irrefutable evidence to build a plan. Does that make sense, BFI? I love that you took this on sim, and I love your line of thinking on the sim. And I love the idea that you're embracing this great termination condition and the clear path down. But I think that if you're going to create a plan, talk about the advantages, right? Talk about all the things that are giving it strength, not than the things that you had hoped are going to happen that might eventually cause strength. Does that make sense? I like it. I like the idea, and man, I embrace the research. But be very, very truthful in your annotation, guys, because your brain thinks that you're brilliant. And your brain, if you say something happened, even if it didn't, is going to believe you. And it's kind of crazy how that works. Mine does it too. But I used to do that to John Novak. Well, I got out with divergence. And he's like, no, you didn't. I'm looking at your chart, silly. Jose, I would get stopped out on this trade every day. You have momentum. You have a termination condition that created a full reversal. You have a clear path. And you have the best freaking entry I've ever seen in my life. Don't be sorry, PFI. You're learning. Guys, don't ever apologize for being in the learning stage. And man, you had the wherewithal to switch to sim to do that craziness, which is brilliant. So I've got nothing but praise for that. I'm just going to try and teach you how to do it better. That's my job. No, Jose, I dare you to find something wrong with this trade. And how do I know that there's nothing wrong with this trade? Check this out. Guys, you can do this. You can take a picture of your checklist, and if you have Snagit, and Snagit's only $63, I can take that checklist and I can drop it down here. So, Jose, the market's coming from a good top. And guys, I want you to see this. You have odds favorable momentum, you have a clear path, and you have an area inside of favorable large triggers. I would be mad as hell if you guys didn't take this trade. And we'll talk about it. But I want you to see it, guys. Two charts. Is there any reason to not take this trade? This is a trade that wins 70 to 80% of the time. This is a trade, and you're going to dissect it and try your hardest to find a reason where you screwed up. Jose, there isn't one. Does one divergence on a small chart have anything to do with a high probability trend trade? Not at all. It did come from a good top. There's your termination. There's your full reversal. Gosh, Jose, this is the prettiest trade you can ever take. And this is one of the reasons why it's so important to post in class. Because if you're feeling some sort of regret about losing this trade, it's just a cost of doing business, guys. There's the same trade. Because it fits the rules 100%, there's no reason not to take that trade. Here, I hope is the same trade. Guys, I want to see all of you taking this loser. But what do we notice about it? And I want you guys to see this. And but they're all the same. I already talked about it, right? What's the one common thread on this one, guys? 3 different users in 3 different time zones with 3 different computers taking the exact same trade. Taking the exact same trade because it provided a statistical advantage. And you know what? The market was wrong, guys, and it happens. But when you write your rules on the chart, it makes it easier. So Dwight, we just found your pattern. You took it too, Alan? Hell yeah. Straight into a termination condition. So Alan, I found your pattern, dude. You love termination conditions. And I'm seeing you trade into them a lot here, right? So that one cost you commissions. And then down here we had, Dwight, there's that gap theory. There's that full bar back to the large triggers, which means that this typically gets run over. And look where your stop was. Right there. PFI, take 100 pictures. Let me know. I trade areas inside of favorable large triggers. I don't care what they are. I don't give any extra weight to any of them. All a midband is a moving average. So Dwight, directly into a termination condition. And then technically this is a termination condition because the large triggers are a full bar away. You lost both of them. Break even is a loss. You lost commissions. You could have avoided that loss by respecting rule number 2. And then you could have avoided this loss with the idea of the gap theory, right? So sometimes, guys, I got to jump in and I got to tell you that you broke some rules. And I do that because I want you to feel the sting of breaking your rules. I want you to feel like, oh my gosh, I don't want to break my rules. My rules keep me safe. You knew that this was a place where decisions are happening. We all did. And there will be times when you take this trade. And Dwight, can I show you what I think makes this trade a better shot? Is if there's no divergence coming from that fib. Let's say that all this momentum and it taps a fib and there's no divergence and strong triggers in a tiny window. I could get on board with taking that shot to see if it retests, right? And then exiting with a lower divergence, not a fluctuation. You knew that this wasn't a great trade, which is why you got in at the bottom of this down bar instead of holding on, right? That's what I would have done. I would have said, hope it breaks. There's a down bar. Oh my gosh, I got to get out. And it didn't even do the full down bar. You just knew that it was close to your stop. You went break even too soon. So don't have a loss of momentum on your smaller, faster chart. It's going to create, at least give you a better chance to get a retest to give you a little more time to manage. Nice picture. And then Jose. I'd have to see the timestamp. I'd have to see the timestamp, but it's just your software recalculating. Maybe you're set up for every 2 hours, and that was just a recalculation of fibs that happened right about here. It wasn't there at the time of the trade, Jose. It wasn't there. Yeah, so 10 a.m. was your fib update. So it wasn't there. And it happens sometimes, right? And maybe that adds a little, but your software hadn't updated yet. That's all it was. And you'll see that sometimes. You'll take the perfect trade and a lose, and then a fib update an hour later will show you an area of support there that wasn't there in the moment. And we can't update every 3 seconds, every 5 minutes, every hour, because it would get overwhelming. No, PFI, the loss of momentum created the divergence. That's the only thing that can create divergence is a loss of momentum. Your software calculates it after the pivot, all the way up here on the third bar. So you have to have a pivot. It was, and D-Rock, it was a beautiful short trade right here. Everybody took it. Check it out. Perfect short. 100% rules met. Perfect short. 100% rules met. Perfect short. 100% rules met. And what happens, D-Rock, is that was the cost of doing business. It's not a lagging indicator. It has to calculate. You can't calculate divergence without a pivot, right? You can't have divergence without a measurable set of criteria. So it's not even that it's lagging. It has to have all the information to do the calculation. So J-Rock or D-Rock, excuse me, that was a perfect example of that 20 to 30%. That was a perfect example of where you can do everything right, and have every advantage, and that market's just not going to give it to you. And it's okay, right? It's okay. It's just a part of trading. But when you write your rules and you see that it had, and that's what he's saying. He's saying if that support would have printed, if that fib update would have happened at 9 o'clock instead of 10 o'clock, there would have been support right there. And then it would have been a termination condition. But as it was, here's the picture again. Strong top, strong triggers, clear path, rules followed, perfect entry, stop hit. Snorri, that was you. 100%. Guys, and I know it sounds silly, but right now, I am so ecstatic that everybody took this loser, that everybody just followed their rules and took the loss because it happens sometimes. I would have taken that one too. And then Dwight, everything says down, the path is clear. You wait for the reversal. You're in at resistance. Boom, bang, easy. Dwight, perfect. Gary, it's your stop. You can do it any way you wanted. The dive, oh, the divergence couldn't, no, it couldn't have. It is technically impossible. Dwight, perfect. Wasn't that easy? And look at this mess over here. Termination, once again. It's 16. Ugly as sin, no momentum, split triggers. Ugh. That's so yuck. Dude, let's get that out of there. And let's keep nailing this one. Beautiful job. And that's the one that we saw live, and you got a better entry than I did. Nice job. Guys, if you make $300 on the perfect trade, but you give away 500 on the rules breakers, you're negative, right? Don't let breaking the rules pull from those beautiful trades. And Dwight, I could teach a class on that one. Nice job, dude. And guys, if you type a question in there and I miss it, please let me know. Um, please let me know. I never skip anybody intentionally, but sometimes I get a little sidetracked. And then Dwight, there's the ugly one. And then this is where momentum could have carried you down. And then it's weak. And then it's weak. And there's no areas inside. And you waited for your rules. Solid. Beautiful trading. Beautiful chart reads. Great execution. Reached determination conditions, but the triggers are still aligned. Let me see if I can get your note from behind there. Considering how strong the move still looks, would it be good to place, would this be a good place to place a look for the next pullback or wait to see if it continues? D-Rock, it can be used as a termination condition. I'll go back to that in just a second. Um, Chef, are you with me? So, Chef, you're asking me, is that if price comes down and pulls all the way back to the large triggers off of a termination condition with odds favorable momentum, is that a potentially good spot to take a risky trade into a termination condition? Jose, I don't know. Double check with my brother. You're going to drive yourself nuts, Jose, if you try to update those fibs faster. There's a reason that they were set at 4 hours. Um, like there's reasoning behind all of it. But John could probably tell you, but I'm not sure that it can. It may need to be written into the indicators. Give me a second, we'll look. Um, so what this is, Chef, and this is pretty astute, is price hit the area, right? And it reacted. So you already got the reaction from the area. So up here is where the reaction happens, right? So I'm not saying that there isn't a potential short there. What did your smalls and large do on the reaction? Absolutely nothing, right? All of your momentum indicators kept pushing down. So, Chef, it's not a high probability entry, but somewhere right around these one-to-ones, yeah, there was a potential opportunity for someone that's checked this pattern out for a while and is good at it. Jose, right click and go to your indicators. My update period is every 2 hours. You can change that. That's minutes. You can change that to wherever you want. You can make them update every 5 minutes if you wanted. So that's up to you. If you want them to update every hour, that needs to be a 60. I personally, I don't mess with John Novak's stuff, but that's how you do it. I remember that from a lesson a while back. I don't mess with his stuff. He's so much smarter than me. And it bugs me that he's so much smarter than me. Chef, did that make sense? And then, Snorri, you were curious about the S&P entry. Let me do that before I move on. This one right here, Chef, here's the beauty, man, is you can do anything you want, right? Someone sent me a message yesterday, and my answer was you can do whatever you want. You can always do whatever you want. You can take any trade you want. Um, it's important that you understand the challenges. So, and here's that same picture, Chef. It reaches Fibonacci support. The triggers aren't really breaking. It's not a pretty look, right? But look how it bounces all the way back to resistance, all the way back to those triggers. It makes sense that this is a potential continuation point because nothing's really changed. So you'll have to find some sort of conservative entry there, right? You don't want to fight that immediate momentum. Maybe you wait for your small triggers to roll and take a little piece on a stab back. Does that make sense? But that's a chart read and not at all high probability. Then I think that's great. And I think that that's smart. Just let it do it. So Snorri, when we look at this one, there's a lot of things going on. Okay, no problem. I'll look for your chart when it comes up. And I think that we talked about it live too, so we'll just kind of go back through it. Post your picture and then I'll come through it. And while you're doing that, I am going to click on some stuff. Gary, everything says up. The path is clear. You take a momentum style and get out at the problem. Solid. And then Ron, I think you learned something from Gary. Oh, similar. Everything says up. Immediate momentum. Clears trouble. Getting in with it. Little aggressive, right? With everything down below. Just taking that little snippet. Ron, I always like looking at your trades. I always learn something from your trades. And then Chef, everything says up, right? Coming from a termination. There's your no divergence, pull back to the area. It's a little outside, and it works out beautifully. Nice job, Chef. Isn't that so much easier, though? You've got the termination condition here, so you've traded into a termination condition. But because of the termination that creates a full reversal that gives odds favorable, you took one shot with no divergence. And I think that this is a fantastic shot for catching the bottom. You see how all your triggers are below resistance? They were here too, and it created a bounce. But here, every chart agrees, and the termination and reversal is true. So that advantage of a strong top or bottom is in place, and it made it a nice trade. And you knew that this is going to be a potential trouble spot. That's okay. That happens. I'm telling you why it worked out beautifully. And it started with that termination condition at the bottom. It started with that coming from a termination that creates a full reversal. And remember, we talk about pivot stop outs when corresponding with fibs are even stronger. So you may have inadvertently just done great things. And it pulls right back to support, and off it goes. And then, George, are you in here still? So, George, here's the small chart example of why those split triggers stink. Because you never know if it's going to go to the area in the large. or if it's going to pull all the way back to the synthetics. So the synthetics on the small chart also give you an idea that they're a full bar away, that same gap theory. But see how you have areas here, you have areas there, and just when they're split like this, there's so much indecision. And when they're one on top of the other, it makes it effortless. It really does. Um, so I'll use the pullback to the triggers, so those synthetics on the smaller chart, to do what Chef was talking about. If everything says down, but I have to let the reaction happen to the triggers, it gives me an idea where that reaction is going to happen. Just compounding on that gap lesson a little bit, I guess. All right, D-Rock posting pictures. Not quite inside of favorable large triggers, so this one would have broken rules just a little bit, D-Rock. But you have a termination that creates a full reversal that gives odds favorable. Everything says down. That is 100% the correct line of thinking. 100%. Your areas inside of favorable large triggers are up here. That would be fudging the rules a little bit. Not a bad look. You just have to keep your stop up here. And notice how it gives you a second shot and it comes back to that mid band right at the large. Kind of cool. Great read, dude. Welcome to Nexgen. And you could add if you wanted to. Not uncommon at all when you're super comfortable with your rules, being able to recognize that the rules are still met and adding contracts. And then John in Alaska, same trade everybody took. Outstanding. Just didn't work. And then Ron, everything says up. The momentum's the absolute strongest, and you take your little chunk out. Chunk, chunk. Base hits, guys. Telling you, base hits will pay your bills. Base hits will ramp your equity up quick. All right, Chris L. All right, Chris, are you with me in the room? One thing that would help me tremendously, Chris, is if you do number 3, right? Actually, if you do all of these. Writing your rules on the chart is going to help me a lot. It's going to help me understand why you did what you did, right? And then showing me where you got in. If you don't want the mess of those entries on there, at least give me a circle. Because if you entered right here, it looks like you entered below resistance with everything down. When ideally, that pullback to support inside of favorable large triggers is a way easier entry for you. And it takes a lot of the stress out, right? Look at how all of your trigger lines are below these areas. Your small triggers are starting to break, but they're not really through. And even your small chart hasn't had time to really say that this bottom's going to work. Does that make sense, Chris? But once everything begins to agree and that momentum comes through, man, that's the effortless one. This is the one that gives you a better chance of success. Great picture, dude. So, Joel, if I'm hoping for a $300 trade, right, and I'm up $250, and the market reverses on me, and I get out, break even, that stinks, doesn't it? Has anyone ever done that? I hope it goes to the next area. But if I take 100, that's mine forever, right? And even if it comes back to break even, Joel, what if I take $100 5 times a day? The highest probability, right? What if I take $100 5 times a day? And let's say I'm capable of doing that every week throughout the month. That's a pretty good year on 5 base hits, isn't it? And guys, I'm not saying that you have to take $100 trades, But what I'm saying is that the point of being a day trader is making money, right? And if you find yourself giving it all back, hoping that it goes to the next area, if I enter right here, is there anything wrong with getting out at Fibonacci resistance? Is there anything wrong with just taking that trade, making 200 to 300 bucks and waiting for the next advantage? And guys, this is part of why it's so important to not take those risky trades, why it's so important to not smash your rules and just say to hell with the rules, I hope it works. Because those are the losers that take away from your winners. Those are the losers that keep your winners from doing wonderful things to your bank account. All right, weak top, odds favorable, all sorts of termination conditions. Let's see what you did, Safia. First trade inside the triggers with the immediate momentum, and you're very cautious, right? You missed your entry on the second, got it in late, and you take money at the fibs. And then you take a short into the termination condition, and it just doesn't seem to work out for you. And then you take it when the small triggers turn, and you're able to capitalize. How's it? I'm sorry. On days when it's frustrating, it's okay. Keep it on sim. Like when you find yourself swearing more than you usually do, it's all right to keep it on sim. I think the most important thing to note on all of those is you're going with direction, you're going with momentum. And it helps a lot doing that. And then, all right, always, Dwight, everything says up. Don't have the momentum. You get in, stop keeps you safe, you take a quick exit, right? Little snippets. Little snippets pay, don't they, Dwight? Little snippets pay. Guys, if it's not the perfect trade, that's even more reason to be a little more aggressive on the management. So D-Rock, the mid band is only a termination condition if the large bars are a full bar away, or the large triggers are a full bar away. So the only time I count the mid band as a termination condition, let me pull up the picture, is if it's reached and the large triggers are a full bar away. That's the gap theory, absolutely. Here it's a termination condition. If those large triggers are all the way here, it doesn't faze me a bit. Termination creates a full reversal. All right, PFI, you said you had a question on odds favorable momentum, right? This is odds favorable momentum. Let's go back to the odds favorable momentum picture. That's hard to say, not gonna lie. I always go back to the lessons, right? So this is what strong trigger lines look up. There has to be that separation. No, you're okay. It's a great photo. I can read it beautifully. That's your odds favorable momentum, right? Guys, it'll never change. It's the separation from the point of separation until they return, right? And then it goes into anything can happen. In the moment, sometimes when it's returning, you don't always see it. So is the origin good? And that means good top or bottom, right, PFI? Let's just go through your checklist. That's a termination, creates a full reversal. I love that. That's beautiful. Odds favorable momentum, not here, but you definitely had it here. That's the one that Chris caught. Clear path? Absolutely not. Price reaches resistance? How many trigger lines broke through there? On the bottom of what? Right here? I see what you're doing. Oh, the trigger's not through here? But price didn't reach it. Price didn't reach the area. It stopped short. So it can't be a termination condition, which means that you're calculating distance to the target from the entry point. Does that make sense? Price didn't reach it here. Not quite. That's okay. But here, price reached it 100%. So the clear path has to be no. The origin has to be good. The odds favorable has to be no. Entry inside of large triggers, you put yes. But everything is below, right? You're okay. So there wasn't momentum, there wasn't a clear path, and there wasn't an area inside of favorable large triggers. This is a great one to avoid. No trade. No rules-based trade. No high probability trend trade. Let's say that. Joel, odds favorable, clear path, didn't make your entry area. Your rules weren't met. You chose not to take the trade. I always support y'all's ability to not take trades when your rules aren't met. All right. I got you. Snorri. So let's go back to basic entry rules. Are you ready? Great questions. Let me know you're with me in here. So guys, favorable large triggers. And I think what happened is we got caught up on the word large. Favorable large triggers is a definition given to the large and the synthetic overlapping. And this is where we're going to look for our entries, guys. Within that range. So Snorri, let me take a picture of your picture. And the cool thing is, and I love that you say, I don't see it this way, because your view is the one that matters, without a doubt. Snorri, are you in here? May have caught him on a potty break. It happens. We drink coffee. Okay, cool. So Snorri, let's talk about large and synthetic, right? Your areas are going to be inside of either the large or the synthetic, but when they overlap one on top of the other, your window of opportunity is smaller. So when we talk about favorable large triggers, we're talking about large, synthetic, wide overlapping. But when we talk about that window of opportunity, we go from the lowest point of the triggers, because it can happen inside the large, it can happen inside of the synthetic, but when they're overlapping, it creates a smaller window. It creates less risk. Does that make sense? So your window of opportunity on this one goes from your lowest point of resistance to your highest point of resistance inside of those triggers. So I think that may be just a little verbiage thing. So it's not just the large. Hey, D-Rock, take care. Overlapping means one on top of the other. So if you lay your left hand on the desk and put your right hand on top of it, your hands are overlapping. Does that make sense? So when your large and your synthetic are one on top of the other, think of like snakes riding piggyback. It creates your smallest window because they're super tight one on top of the other. So when they spread a little bit, it's still the lowest point of resistance to the highest point of resistance, and it becomes a little problematic. And I think your fibs were a little different on the S&P. Maybe we need to get you to refresh. And then over here, and you were waiting for up here, but technically this fib right here falls in the window. But your fibs look different because I believe This trade had a fib somewhere right around there at 11 for a lot of people, which made that entry make sense. So on yours, it probably wouldn't have because you're not going to take it before the market ever reverses, right? So where you were looking was a solid place to be looking because you didn't have the advantage of a fib there. Does that make sense? Does that cover the first one? I think that that was a great picture. And then here, it's going to be the exact same thing. From the top of your triggers to the bottom of your triggers, I'm looking for areas inside of those trigger lines, right? So this resistance falls outside of them. It goes beyond where that window is. And that's what I was talking about when I was saying that this isn't inside. So what do we notice just on this chart? I see a loss of momentum, right? And I see small triggers working their way back inside of the large triggers. And I see that my only area of resistance is on the wrong side of those large triggers, on the wrong side of those momentum indicators. And that's a great indication that that's a good one to just kind of let go. And then on your larger chart, it was the same thing. On the larger chart, you were losing momentum as well over there. But your fibs look different than a lot of people had on that one. Um, every morning, Snorri, do you go through the, get up here. Do you go through the Ninja 8 bet? Okay. It may be a days back issue. Are you on Eastern time zone? When fibs don't line up, I like to ask, because you can see how these looked over here. Let me go back to it on my chart. And I seem to be consistent with everybody else. So I had that fib that you didn't have. And then as it came down in weekend, you had the fib that I didn't have. Um, so a little different look. You're on NinjaTrader 8, yes? Let me give you something that you can do when you have a minute. This helps a lot. Jose and I were going different directions one day, and this cleared him up. Um, Making sure, like try resetting and repairing your database. You do have to disconnect from NinjaTrader to do it. It takes just a second, and then you reboot it and comes up. But what that does is it pulls any corruption out of there, and a lot of times that helps a lot to get us on the exact same page. All right, Alan, for this trade, the context of the great bottom will allow me to look for the next area's targets. I love that. Termination conditions that create full reversals add strength. And it's medium probability because it's 50-50. Crazy strong triggers, little window of opportunity. And you hesitated because you had just taken a loser on crude oil earlier. Alan, thank you for posting that. Thank you for saying that you hesitated because of what happened on the last trade. Guys, this is normal. This is human nature. This is why we don't rest our hands on hot stoves, right? Because when something hurts you, you're less inclined to do the same thing twice. Trading is a little bit different, guys. Trading is about having advantages and trading the odds, right? It's like flipping a coin. If one side's weighted, you're always going to call that side, right? And you know that it may not always land on it, but it's probably going to do it more than it doesn't. And Alan, this is kind of letting the past predict the future for you. You're still a little gun shy because of the loser, and you're like, this one hurt, so I'm not going to take that one, right? And that's okay. Totally cool. But guys, this is the trust process. This is taking 300 pictures of high probability trend trades and proving to yourself that the advantages come through for you. This is taking those termination conditions and proving it. And Alan, it's totally okay that you didn't take this trade. And it's even better that you went back and reviewed it so that you don't miss it next time. Great pictures, great annotation. I mean, guys, this is how you become a day trader. Constant study. And then Gary, was that Gary? That was Joel. Joel, Rockstar. We just talked about it. Nice job. Joel's like, I can do this. Have you met me? And then Paul, good morning. 50-50, no divergence, in at the area. You take quick profits at the trouble and you're not willing to give it back if it changes its mind. Guys, this is how you take a medium probability trade. We don't hope. That's a base hit. Where was your exit? Your exit was at 91. So Paul is already $100 and secured 50. That's a medium probability trade, guys. That's what you do it. Nice job. You took the same one, Jose? Did it go for you guys? Did it drop all the way to fibs? I hope it did. And then Gary looks like he took the same one too, 50-50. Gary, you robbed yourself with that confirmation. You increased your risk on the medium probability quite a bit. And your rules say enter at the area, right? So Gary, you got a little squeaky on your rules there. A little nervous. And then Paul, it took you out and then went again. It hit your break even and then it went. That's it. But you managed it per your rules, didn't you? You managed it 100% by your rules. And then Jose, same thing. Beautiful entry. Solid divergence prints, and that becomes an exit condition because of the bad top. Guys, both of you managed this trade beautifully. Both of you managed this trade 100% by the simple plan. I don't know if you knew that or did it unintentional, but you took that KISS plan and no divergence in at the area, right? And that's awesome. And then you took profits at the first trouble spot, and that's amazing. And then when divergence prints, that's an exit condition. Guys, I don't think that you could have done that any better. I don't think there's a better way to take that trade. Nice job, guys. And we made it to the end of the pictures. Let's see what the live market's doing. The S&P is at resistance with no triggers through. There's that 50-50, but guys, look at this. So this was a trade, right? Does it mean it's over? Now I've got strong triggers, and I'm almost completely broken. Do I still have an area of resistance inside of favorable large triggers? In the event that they decide to come back? Triggers are inside. Which direction are they pointed, though, Paul? That's okay. Not Paul's trade. It's still a 50-50 scenario, right? That's where it's likely to bounce. Let's see if it does. It might not. You've already had one divergence in there, right? A little bit of indecision. We'll see what it does. Guys, only you can answer whether or not this is your trade. Only you can say whether or not this is worth risking your money on. We can identify trend, we can identify momentum, we can identify where the market is likely to continue, and we can make the choice on whether or not we take that trade. That's it. That's all you can do. And you have an HVA line supporting it as well. But doesn't this go back to the idea that decisions are made at fibs, guys? Look at the up and down on your smaller chart as decisions are being made by the fib. Doesn't it make sense when the buyers and sellers are fighting? And the further away from the fibs we are, the easier your trades become. What do you guys want to talk about? We have 30 minutes. You're never guaranteed a winner, right? Never guaranteed a winner. You're never guaranteed riches and fame, but I can tell you, you'll get to the point to where you have a better shot at it when you follow the path, guys. And to minimize your learning curve, you have to post pictures in the room. This is where people start jumping ship. Post your pictures in the room. Big Al, I want to see pictures from you, man. I can't help you if you don't give me the opportunity. Show me every trade, win, lose, or draw. Show me every thought visually. If you win and the rules are wrong, you may have a short-term victory, but a long-term failure, right? Someone told me earlier that they fought everything but made $300. How many times is that trade going to win? Less than it loses, right? But to be sure, you got to know. You need feedback, and I'm here to help, guys. I'm here live 15 hours every week. 15 hours. My sole purpose in life is to get you where you told us you wanted to be. Is to analyze everything that you see and everything that you do and look for opportunities to make you better and to help you go down that path of creating recognition through repetition, through having a plan, through following a plan, through having rules that win more than they lose. Um, and if you're on the simulator, guys, if you're participating in class, you can't lose money. Can't happen. It's just time. Time is precious, but you're not losing any money. You need someone to tell you what you did right or wrong, guys. That's what I'm here for, is to tell you what you did right or wrong. And that's what Nexgen's been doing for 20 years. We've been working with people, personal, just like this, one-on-one. Every time you post, we talk. Take advantage of that. Paul's rules kept him out, didn't they? It's a 50-50 with a divergence. And Paul's rules kept him out. Nice job, Paul. And that's why I always say, you got to do the work, guys. You got to do the study. You got to figure out what works for you. Um, this is one of my favorite things. And this is for new users, and this is some Mark Douglas wisdom. When you stop expecting to win every trade, you're going to start winning most of your trades. If you don't care about the result, but rather the execution of the method, because the method needs to be proven to win more than it loses, guys. That's a big thing. Um, Chris, no. Oh my gosh, that's a lot of words. Clear path equals coming off of. No, it's okay, man. It's okay. Everybody's brain works different. Everybody sees and hears things differently. And sometimes we create rules in our heads based on our perceived understanding. And if you never post that in the room, man, we never get to have this great conversation. Let me show you how easy it can be, Chris. Price reaches an area. If your trigger lines remain below, and this may be exactly what you said, but my brain didn't process it. If all of my trigger lines remain below this area of resistance, I'm not trading into it. My path isn't clear. This is an area that may reverse the market, may create a bounce. Once both of my small and large triggers get above this area of resistance, my path is now clear. The area is considered broken only when both the small and the large go through. Does that make sense? So that's terminations in its most remedial form. But strong triggers break things, Chris. So let me show the third potential option. We know that no triggers is no clear path. We know that both triggers is a clear path. Sometimes the smalls are going to start to break through, but the large won't. And this is what we call a 50-50 trade, Chris. And for everybody in the room that's not really familiar with this concept, this is what we call a 50-50 trade. And all it means is that 50% of my triggers are above and 50% of my triggers are below. Strong triggers break things. So the key to this, look, that when both triggers break green, no. Green is a color, not an area. If none of your triggers are through the area, Chris, you don't have a clear path. If both of your triggers are through the area, you have a clear path. That's it. Has nothing to do with colors. Has absolutely nothing to do with colors. Because check this out. That fib turned blue, didn't it? It turned into support, but the area is not broken yet. And there's a fib change color as well, right? This used to be support, but it turned into resistance, but the area never broke down here because both the small and the large never got through. So even though this turned into resistance, it never behaved as resistance. The area never broke. Does that make sense, Chris? So don't get caught up in colors. Guys, colors will wreck you. Let it be simple. Let it be either the triggers break or they don't, and that's your clear path. And then when you have the best of the best momentum, that strongest momentum known to man, right? That odds favorable momentum, and you're coming into an area, the area only has the potential to break. It has the potential, but it hasn't broken. It's not a clear path. And you can see here, that potential was never realized. It didn't break. The market reversed. But here, it did. So those are kind of your options right there. PFI, if 3 trigger lines are through, and there's only 2 triggers. So let me answer that in 2 parts, right? PFI, your small triggers are 2 lines, your large triggers are 2 lines. Oh, John. That's okay. I'm gonna give you something on this one too, though, PFI. Um, because I think that it's key to what we talk about. In one of the rules that the trigger lines define so much, guys, like here the smalls went through, right? But they barely went through. Fibs are where decisions happen, guys. Fibs are where fights happen. Fibs are where buyers and sellers pull off the gloves and they're going to make a decision. They're either going to break the area, they're going to sit at the area and fight, or it's going to reverse instantly. So, what I want you guys to realize is that the closer we are to these areas, the more challenges there are. Ron, have a good one, right? The more possibility there is for this fight to happen. Does that make sense, PFI, so far? Because I'm growing towards something. Fibs are decision points. That's all it is, right? So if this area is going to break, let's say these are my small triggers, and I'll use these, and my large triggers are trailing, but they haven't broken. The further away from area price gets, the further away those trigger lines get, the more likely it is to break in a lot of instances. So if half of my triggers are through, my price is all the way down here, away from that decision-making zone. Does that make sense? So when you have those 50-50 trades that are barely peeking through, guys, you're still just stuck right in that decision making. But when those large triggers start to come through more, it becomes more likely. But until they break, you're still in the decision making area. Does that make sense? And I took one more picture just to show you how violent it can be on a smaller, faster chart. These fibs are in the decision making area, right? Look at that smaller, faster chart. Look at what's happening in this box and compare it to what's happening in this box, guys. This is buyers and sellers fighting it out at fibs. I'm going to tell you right now, John Novak's fibs are freaking amazing. To the tick in a lot of cases. The further away from fibs you get, the less decisions are being made. And next gen users, you capitalize. when these areas clear. That's the easiest best of the best. Alan, 50-50, no divergence, great entry, out at the trouble, out with divergence. Awesome, Alan. You, Jose, and Paul took the exact same trade with the exact same entry with the exact same management, and you all did it wonderfully. Nice job. PFI, odds favorable from a bad top, right? Is it a good origin? Nope. It's a pivot that comes from in between the areas. So bad tops aren't strong tops. You do have odds favorable. You don't have a clear path because the large triggers aren't through. Are you with me so far? Doesn't matter. You're making stuff up, aren't you? The large triggers aren't through. The large triggers aren't through. There is no 3 or 4. Your small triggers are 2 lines. That's one trigger. Your large triggers are 2 lines. That's one trigger. So for the large triggers to be through, both lines have to be through the area. So we're still 50-50. And you'd already had that one divergence, right? This was your best trade. The one that Paul, that Alan, that Jose took, that's the best one. That's no divergence and strong triggers. Well, here we get a loss of momentum and the triggers weaken. Here we still have weak triggers, right? And look at the split. They're starting to break apart. They're starting to show indecision. So what you did is you missed this one. You didn't risk this one. And that's the third shot. That's the third round of boxing happening at that key area. If a 50-50 doesn't go from here, man, it's probably not going. Second and third attempts on 50-50 trades rarely work. Does that make sense? It's a great question. And then the flip side of that is, yeah, when these triggers start cranking through like that, the likelihood of it breaking goes up unless your small chart is telling you that that momentum's going away. See how they're super strong right here? And they're kind of hemming and hawing here. They're down, but they're still inside. And Paul said with the smalls inside, he wasn't taking it. Yeah. It's great questions, man. And then George from a termination, odds favorable, pull back to the area of resistance inside of favorable large triggers, and you make money like it's easy. Nice job. Great trade. Your large chart had some termination conditions, but you were banking on it with that. See how the good top, guys, changes the world. Good top changes the world. Nice job, George. And guys, I'm going to tell you right now, you're going to learn the basics. You're going to learn to read your charts, and then you're going to start applying it. And every time you apply your rules, what you're doing is you're recognizing patterns. Every time you take a long, every time you take a short, every time you annotate a chart, you're recognizing patterns. This is the NASDAQ. And there was George's trade. And then you NASDAQ traders, here's small, strong triggers coming up against you, which tells you don't get into the trade. Telling you it's NASDAQ specific. And then the S&P is sitting right there at resistance as well. And then Chris, this becomes clear path once we break through the fizz with both triggers. Absolutely. And the significance, these are all fibs, Chris. Every one of them. Yeah, you did. NASDAQ has, I don't have a 21.3, George. So I don't trade the 21.3. So I don't even know what that looks like. But that may help you a little bit. We sound like South Park characters. I don't think that's very nice. All the triggers have to get through it, Chris. That's the most important thing. They're just small swings, George. But you're on a different time frame, right? You're giving yourself three different time frames to look at instead of two. Absolutely. So, Chris, let me show you how fibs come to be. Um, I love sharing this picture. I really do. So when you open up your software, your pro trader is analyzing data set for the last 10 days, and there are literally thousands of individual Fibonacci calculations. Chris, I mean, it looks like this. These are all fibs. And this is what the software goes through. So it goes back 10 days, it does it on all the time frames, and then it begins to go through on which ones are important, which ones have the highest concentration. And sometimes you'll get such a high concentration in an area that you'll get multiple fibs within that area. And just what it means is that there were so many calculations that said this is an area to watch. Um, that, yeah, absolutely. You want to get those trigger lines on the business side. Does that make sense? Break through them all. Get that clear path. And then, Chris, you're going to learn when it's okay to take that smalls through large knot. Coming from a pivot stop out increases the likelihood of success, right? The best of the best momentum increases the likelihood that the area is going to break. It never guarantees it, but it does increase the likelihood um, because strong triggers break things. But when we talk about keeping it super simple, and then George, that's what it is. Those are small swings. There's smaller swings in the market rather than those big yellow one-to-ones. That's all it is. And they show up on NinjaTrader 8. I don't have them loaded on NinjaTrader 7 because I don't have a trading plan that uses them. But they can create little bounces every now and then. And then, Chris, compounding on that 50-50, when the smalls break through and the large don't, we know that the path isn't clear, right? So we talked about that. We keep it simple. We're waiting for the large triggers to get through. This is where you can use that small chart to gauge whether or not it's more likely to break. We already know that it has momentum, right? And we know that it has the potential. So when it comes from a good top or bottom, when it comes from a termination condition, it increases the likelihood a little bit. When there's no divergence on your smaller chart, it increases the likelihood because we're not giving up momentum. And then when the smalls are outside of the large, it's actually confirming the momentum, and it helps us say, yeah, this is more likely to break. And then just going into it, because it's not broken, because it isn't high probability, having that small little window of opportunity, being able to minimize your risk on a trade that isn't a high probability trade, for me, for my money, it's important. And then I've got another 50-50 right here. Everything says up, everything is strong, no divergence, strong triggers, and there's really only one line where I'm anticipating that market to go from. So it starts on the large chart. Just because it's not broken doesn't mean there isn't a trade. It just means that it's okay to say I want my small chart to be perfect. I want my small chart to have all the advantages that I'm looking for coming into it. And then that really simple plan that I gave you guys, it covers the 50-50 trade when an area isn't broken. And it reminds you that the large chart should be its absolute strongest. And it reminds you that the small chart should have that momentum. And this is a key factor for me and for new users. No divergence on the smaller, faster chart. Because that loss of momentum is an advantage, right? And we rely on the advantage of momentum in the clear path in the entry area. So if I already don't have a clear path, it's okay to insist on momentum. And then from a good top or bottom increases the likelihood. And then I'm going to enter at the area. And if there's divergence on the trade, there it is right there. It reminds me again, don't get in with that loss of momentum. And then management on it is the same thing, using that window of opportunity, using reversal. And notice that it says for the third time, if divergence prints, exit the trade. That becomes an exit condition because you're giving away those advantages. And Chris, this one is designed. This is the super simple. This is the simple plan for consistency. And ultimately, you will craft a plan that goes outside of this. You'll create a plan that goes beyond that, and it'll help you make those decisions on when you're willing to take it. I don't use market flow signals, George. And these aren't necessarily my rules. These are simple plans for consistency for the new user. George, I'm not going to lie to you. The only thing that I use market flow for, the only reason I pull up a market flow chart, I'll show you exactly how and why I use it. The only thing that I look at are the trigger lines. And I'm making sure that if I'm looking for a trade, in my plan, this is my plan. If I only trade NASDAQ, so it's a little different than crude and ES. The only thing I use market flow for is momentum and making sure that I'm on the right side of momentum. That's really it. I don't take signals. I don't look at bar structure, bar patterns, anything like that. I don't worry about where the dots are, stranded sellers, stranded buyers. It's just too much for my brain, George. And if I give this chart more credit than I'm capable of processing, all it does is it has me making bad decisions based on a chart that isn't even my rules. So I could literally use an 8 range chart like this. Odds favorable momentum, right? But George, odds favorable momentum, even on a market flow chart, doesn't take away the fact that this is a rock solid termination condition. So this chart a lot of times is going to make people, they think it's magic, right? They think that this 8 range chart is going to get them more trades. They think that this 8 range chart is going to get them, and I'm not saying that you do, George. They think that this 8 range market flow chart is some magic win builder, but it's really not. It's just a confirmation tool. That's all it is. It's just a confirmation tool. So even with this signal on a market flow chart, George, I'm not trading in determination conditions. I refuse to do it. Does that make sense? Awesome. I am such a fan of simplicity, guys. With the path clear, and then you hit the next lines, right? And Chris, this is one of the challenges of patience. Your question makes perfect sense. Termination conditions are good to the next termination condition. So when price reaches resistance here and no triggers are through, it's a termination condition. You have to respect it. When the smalls are through and the large are not, this area has the potential to break. Notice how it hadn't reached Fibonacci resistance yet? Your entry came from down here, which means that that becomes a beautiful target. And the process just repeats itself all day long. And Chris, this is why I say about 10 times every day that 90% of what we do is going to be reading charts, and 10% is just waiting for those advantages to be present. And what you're going to find is that if you start weeding out the maybes and really go for the high probabilities, um, it gets a little easier. It's boring. Successful trading is boring. John Novak typed that in the room the other day. Successful trading is not a lot of fun. It's not action packed. There's no fireworks, no shootouts. And sometimes you just got to sit on your hands and do nothing because there's nothing to do. That's a great question, though, because it happens every day, right? This area breaks. No. Limit orders at pullbacks to areas inside of favorable large triggers. Limit orders to pullbacks at areas inside of favorable large triggers. Rule number 3. If you just kept putting limit orders at fibs, that one loses, right? And that one might lose on a bounce, and that one loses, and Indecision here might pull you out, and indecision here might pull you out. So it's an accumulation. And then George, here's a great example of why market flow signals mean absolutely nothing until your rules are met. Because that is certainly termination condition for the win, isn't it? At least in the moment. So Chris, we're respecting the fib. Yeah, exactly, George. So we're respecting the fib because the trigger lines aren't doing anything the same way we respected this fib because none of the trigger lines broke through. So now we're just kind of in a holding point. Which one's going to win? Are the buyers going to win or the sellers going to win? And when you get caught in these ranges, and let's see if we can find an example. When you get caught in these ranges, it keeps you out of a lot of trouble. And it's so hard for new users to just accept that sometimes there just isn't anything to do. You just have to wait for it to break out. And if somebody told you that it was going to be nonstop action, they lied to you. But I can tell you right now that patience pays dividends. And the most successful traders that I know have a very solid plan that wins more than it loses. And their trades all look the same. So Gary, 50-50 into the mid band, two areas not broken, divergence prints. There's a lot of problems going on with that one, right? There's that market flow order, right? But, oh, it's so ugly. Nice job. Awesome, Chris. And I'm telling you right now, it's going to be helpful every day. So keep coming in and keep asking these questions. And Safia, I'm Ninja Trader 7, so we may have different data, we may have different everything, but this is what mine look like right now. Let me know if that helps. I love the journey, guys. I love the idea that we can do this every day, that we can be comfortable every day, that we can throw ourselves out there and look for the best of the best, and just wait for those advantages. Yeah. So let it be the whole, right? Let it be the accumulation of the three, Chris. I do too. I only have one pivot. I can't have two divergences unless you're talking about on the bottom. Then yeah, I guess I had two here and I had a higher one here. So right on. I was like, I haven't even had two pivots yet. Yeah, Chris, I did it too. And sometimes I said because this fib is blue, I have to go up, right? Or I said because one of the large trigger lines are through, then the area is broken. And we all do it. And eventually we just kind of reel it in, and get to the best of the best. And we get to what works for us. So, guys, great class. That's it for me today. A lot of